All right, everybody, welcome to the DPW Holdings Investor Day. This is something that I wish we were having when the price was a little bit better, but we're not going to focus on price. We're going to focus on value today. The entire presentation today, those of you who are in the audience and those of you who are on the internet and those of you who will be watching this in the future, because it will be up live for 1 year, there's a safe harbor. I'm not going to read the whole thing, but when you're watching this or reading this, we expect that you have read the safe harbor statement. Our statements are forward-looking, and for argument's sake, this covers everything we need to cover in terms of safe harbor. The presentations will be done today. We already had breakfast. Thank you guys for coming. We will be, Will and I will talk in the beginning. Then we'll have Bill Corbett from Digital Power Lending. I'll talk about IM and the hotel. Darren and Marty will talk about, along with Jay, talk about digital farms and the opportunity there. Amos will come on and talk about Coolisis and the defense side of the business. We'll have Power Plus. Russ, newly appointed CEO of that division, will be on. Then we'll have a special presentation from one of our outside investments in Sandstone. Stefan Jackman came up from Atlanta. He'll be speaking about Alzamend, which is an exciting opportunity for DPW long term. And then Phil Mensa will wrap it up in terms of outside investments. We'll end it with our largest outside investment and our largest single contract, if you exclude Microphase and the Air Force, which we'll get into later. And then Will and I will wrap up with some closing remarks. All right, well, we are operating under safe harbor, so I know a lot of times we read this, but please make sure you read the safe harbor statements. The mission, I keep, pounding this, that we buy undervalued assets, disruptive technologies with a global impact. One of the biggest global impacts, obviously, is the reduction of wastewater and chemicals in the space with MTIX is a really big investment for us. And this is sort of the mantra that I've been under, good or bad. I'm going to have Will chime in a little bit about who he thinks we are, how we got here. We're going to do this together a little bit, the opportunities that lie. You heard me privately before we went live that we're a small private equity, venture capital activist firm. We operate as a holding company. We got here because the old Digital Power that had been traded for about 19, 20 years on the New York Stock Exchange was in danger of being delisted, and we had an opportunity to buy the stake from the former chairman. And how we got to where we are today with multiple divisions of the company is through a series of aggressive acquisitions that we thought would make sense. Many people probably saw that we took the natural power supply business that made power supplies that were used in the crypto space, and that turned into sort of an uncontrollable Bitcoin story, one where we kind of lost control of that narrative. Went from about 2,600 shareholders to about 35,000, and so there's somewhat of an untold story about what DPW Holdings is. There's a lot of opportunity with the company, with the assets they purchased. We're going to talk about that today in terms of the individual silos, whether it be defense with Microphase and Enertech and the opportunities in India, or the opportunity for MTIX long-term, the long-term manufacturing contract for MTIX, or our long-term investment there. We're really excited about what we're doing with Alzamend, and even though DPW has a very small stake, somewhat unreportable, it's so small, we expect that to expand and get larger over time. It is related party because I control Alzamend from the preferred, so a lot of times you have to take a lot of extra care when you make related party investments with the independent committees and stuff like that. So it's not as simple as me making an investment as it would be to something that was non-affiliated. We were a private company, non-public. You would not value the individual businesses the way they're being valued today. And that's probably the narrative going forward, is that there's an extreme amount of opportunity in every silo of the business, And if you were private, you wouldn't be getting the kind of valuations you are now. We clearly believe that it's very undervalued. Will, do you want to comment on that at all? That Will and I kind of decided that we would comment from time to time on where we thought value was.
Sure. So, candidly, I think there's a disconnect right now if you look at our underlying assets. Take Avalanche or MTX International, for example. Here's a company with a market cap of a couple $1 million if you just look at common shares outstanding. But if you look at the opportunity, and if you were to take this to more of a traditional private equity standpoint, you would see significantly greater valuations for the actual asset. And of course, that asset is held at DPW, which again, it's really our largest investment. You've got a total of about $14 million invested. Now, not all of that is convertible notes, and not all of it has warrant coverage, but it's a significant asset.
We've got about $14 million in it. So
yeah. What other assets did you want to talk about specifically as far as?
Well, I think defense I think the defense business is very undervalued, but I think that you hit the main point about the theme of the conversation.
The problem is I think the public markets, when they're looking at public companies, they're really focused on earnings. And right now, we're an early stage company in a lot of respects. MTIX is early stage. DPW is in a restructuring mode. DPC is, I should say. Enertech is a recent acquisition, and it takes time to, I guess, digest all of those acquisitions. That's the biggest issue right now, and it's all recent, and there hasn't been a lot of news, and it's only been, I guess, conveyed to a small investor group.
Will and I have this thesis that basically no one's really paying attention to the assets, and so we think that we goes to our next plan in terms of.
Well, I think they're focusing on the debt,
right, and how we realize the value of what we have, and some of that will mean that some of the companies inside the portfolio won't be here a year or two from now. Whether that means that they're sold or spun out, etc. Everybody probably remembers that we recently said we were going to be doing a deal for Digital Farms in which we'd file a Form 10 and eventually issue a dividend. So that we're going to focus in this conversation about, and towards the end, about what we're going to do to sort of realize that. Can you go to the next slide for us, please? This is, I was with an analyst this morning for breakfast from a fairly decent mid-sized firm, and he said to me, as we got into the conversation about the financial group, the other bets, and DPW technology, he said if you were a $500 million market cap, if you were a $1 billion market cap, no one would be having the conversation. But you're a $10 million market cap with a few companies in here alone that would be valued at $10 million. So it becomes a much more complicated story to tell when you have such a small market cap. I'm going to comment on the other bets by saying that Will and I, who run Alton Company, we've been buying stock from DPW, and I'll be using a term called look-through, right? But right now, to look through DPW down to the assets, it's actually cheaper for us to make an investment in DPW than it would be to make a direct investment. MTIX International, for example, is not raising money at its current private valuation. So it makes sense for us to be able to buy DPW at Alt. We get more ownership, and from a look-through price, we get to purchase more of these investments at a fraction of what we'd be paying them for them. And I'll lead off with one example, and that is that Digital Power Lending has the same license as On Deck, has the same license as SoFi, is expanding its loan portfolio, will eventually build its own balance sheet separate away from DPW Holdings, but consolidated on DPW Holdings. I would argue that that business alone is worth more than all this in terms of current market cap. The MTIX transaction is a very long tail investment. Now, Bill and I have had a lot of debate about how it be funded, and it does need an industrial partner because with 50,000 opportunities for textile plants around the world and 50,000 in China, it's going to be a big rollout. and it's going to take 20 years for that disruptive technology to flow through the finishing process with MTI in the textile industry. But that contract alone, done correctly, long term could be $100 million a year in manufacturing for DPW's subsidiary. So we have a very long view, and you couple that with we borrowed a lot of short-term money, and we had a lot of short-term investors. Remember, I talked about we went from 2,600 investors to 35,000 shareholders, and about if I got 100 messages, 80 of them were "you're fat and ugly, Todd," and the other 20. Sorry, that was a joke. I am fat and ugly, but that's another story. 80 of them were about Bitcoin, and the other 19 to get us to 99 were about "you're fat and ugly" and how's Bitcoin. And so we got a very. I'm not saying I didn't appreciate the shareholders were there. A lot of the opportunity to capitalize the company came from them. But the thought process was very disjointed about what the assets were going to be. And kind of still today, I got a text from a major shareholder who said to me, "What is Sandstone and what is IM?" And I thought to myself, well, we've owned some of these things for 18 months. So what we're trying to do with this meeting today is to take our time and kind of explain where we are. Clearly, I'm not putting good money after bad. Will and I believe longer term, and we have had successes over time, that this story will play itself out and provide economic benefit for everybody. But right now, from a look-through basis, it's cheaper to us to buy DPW than it is to buy the investments directly. And this is why you see DPW, when it gets new cash from alt, making additional investment. There's a disconnect in the marketplace. I can put money from alt to DPW, and they can make investments in these other vehicles on a cheaper basis, and so therefore this cycle continues. I don't envision us getting smaller. I envision us getting bigger, but I do know that the board and Will probably thinks that this is enough for a while. I can tell you that this is probably the portfolio for a while. Any comment there, Will?
Well, I think it goes back to what you just said. If an investor is asking you about IM and Sandstone specifically, it goes to the complexity of our financial statements. The IM transaction, when that was consummated last year, it was disclosed immediately, and it's all over our 10K and 10Qs. Sandstone Diagnostics, the same thing. They're in there, but you're talking about a company with so many subsidiaries and so much going on, it does make it very confusing for the investors to comprehend. Let alone there's not a lot of information out there yet on some of the other investments like Avalanche.
Right.
So it's a challenge.
So we're open-minded to where things end up, and what. If the perfect example of this is digital farms. That's the old super crypto. We're diversifying our opportunity here by having a data center investment we hope to close in March that allows us to change the risk profile of Bitcoin, change the risk profile of mining, align ourselves with two experts in the space that have a stellar record in data center, allow us to expand to rendering, 5G, they're going to talk about that today, while still being able to turn on those miners when we can and turn them off when we need to. And Marty has negotiated a really stellar long-term contract for power, which brings our power costs down. Now, I know there's a debate in terms of impacted cost, actual cost. I'm sure Marty would say, well, what's your actual cost? But we're going to spend 4.7 cents a kilowatt hour to mine Bitcoin, and that's substantially down by more than half of what we pay already. And then, of course, this facility is remarkable. So there's a lot of undervalued assets here. Will and I continue to put our money where our mouth is by buying more. And I've said, I think publicly 100 times, I'm going to buy more. I beat that into the ground because I don't want anyone to be surprised that I'm going to buy more DPW. Alton Company is going to buy more DPW. This is the current structure of DPW. What you don't see up here is the hotel. What you do see up here is two distinct categories: DPW Technology Group, which is made up of Amos and Russ. Amos runs, let's be clear, Amos has been here for more than a decade, so he has significant influence on the old Digital Power Corp, Power Plus, the acquisition. Amos has really been around a long time and knows the space very well. Russ is now running Power Plus Electronics, where we're going to build distribution there. Coolassist has Gresham Power, Microphase, and Enertech. A lot of opportunity in India with Enertech, expansion of manufacturing on the defense side. Microphase is being right-sized. We had a new hire in David Katzoff, is really instrumental in helping us clean up Microphase to right-size the business. And then over on digital DPW Financial, we have Billy Corbett running Digital Power Lending, Darren McGough running Digital Farms with Marty and Jay, and then IM Hospitality run by Kraus. The restaurant group, I'll cover this later. I can see that restaurant group being spun out to shareholders. In fact, I would argue that it's very likely, because they want to grow, that they don't meet the same criteria as to where we would want them to be in terms of does the story make sense. So I think you could look for the restaurant group to later on be part of a different business and look for DPW to monetize. One of the themes you're going to hear from Will today is that we want to bring down our short-term borrowing to zero and want to lengthen out our borrowing to match our long-term assets. These are our shots on goal. Every one of these shots on goal to me represents an opportunity for value to be created by one or two of these shots going in the goal. We're going to be talking about lending, defense, blockchain, biotech, hospitality, power solutions, and advanced textiles. And this is sort of the theme that when you own digital power, you got a lot of shots on goal. We may not all agree on how we should get there, but we do have a path that we'd like to sort of lay out. With that in mind, I'm going to bring up, I think the first speaker is Billy Corbett. This is the leadership team. Myself, Will Horn, Darren McGough, Ken Cragen, a recent hire in the last 5 months as Chief Accounting Officer, David Katzoff, which is in the audience. David, could you raise your hand? Joe Spaziano, our Chief Technology Officer. A lot of people know him as Crypto Joe. This was critical. The new hires is probably a little unusual to segment the way it is, but believe it or not, all of these companies were handled by Will and one other person. And I sort of begged for Will to build a bigger back office. And now that we have Ken Cragen, our Chief Accounting Officer, he's also the CFO of Alzamen now. Will is no longer the CFO. David Katzoff is Senior Vice President of Finance, and he is the CFO of Digital Farms. And Georgia is our controller. This has been instrumental in us helping us figure out how we'll be able to monetize assets, get reporting a little tighter, ease up things for Will so he can get all the companies properly reporting. Some of them are voluntary. And for us to take on greater responsibility in terms of monetizing value. David Katzoff, Ken, and Georgia have been instrumental. David has turned the holding company into really as some of the people that work with me, especially my assistants, would say, this is getting very corporate, is what they say to me. But it's very welcomed. We're getting a lot more disciplined having David there. So we're pleased about these new hires. Okay, I'm going to introduce Billy Corbett, CEO of Spyglass, which is a subsidiary that owns Digital Power Lending. We'll get into Spyglass later in the year and explain what Spyglass's products are. But this first quote is really important to us because it's an underserved market. Billy brings us a lot of public company experience, a lot of pipe experience, and he's going to talk about a recent transaction he did in the last 7 months, which we realized this is a transaction where we lent money, made money, converted out in the public space under the umbrella of Digital Power Lending. Billy Corbett.
Hello. Thank you very much for coming. I'd like to also thank everybody online that's participating. We really appreciate the time and the support. So I think this slide is paramount. it really gives you an idea of what's going on in the marketplace with, $200 billion worth of loans over basically about 24 million loans. And there's an unmet demand out there. Actually, this is about a year old. The new numbers are somewhere around the $100 billion unmet demand, which is pretty exciting for us as we look at it, because we can bifurcate the division as both public and private, and gives us an opportunity to really grow and ramp this business, which we're just actually underway with the California Finance Lending Arm license that we got in February of 2018. And that's really the critical point of this business, is the ability with this California Finance Lending Arm to go out and charge origination fees, to bring in syndicates. As Todd mentioned earlier, it's a lot like SoFi and On Deck, with the ability to really be a part of companies both on the public and the private side, as far as the capital that we can give them that's secured, that can convert and develop a portfolio of warrants at the same time. And we can talk about that as we go along. So basically, Digital Power Lending specializes in providing capital financing for small businesses through innovative products and services. DPL is really a referral-based business seeking unique opportunities to assist in the growth of dynamic companies with operational experience, good management, and market-accepted products and services. DPL is a limited liability company and a wholly owned subsidiary of Spyglass Hill Capital Lending Corp., which is a Delaware corp. Spyglass Hill Capital Lending Corp. Operates monthlyinterest.com, which is a new online portal that facilitates investments that pay monthly interest. It enables individuals to select industry, the length of the investment, and the interest rate that best fits their needs. Investments may be made across a whole host of different businesses. Primarily now we're focused in our real estate developments. We look at high-tech companies, both private and public, commercial lending, merchant cash advances, and other pecuniary projects. Important source of the private funding for DPW comes from this, and DPW's investment portfolio and divisions, as well as our subsidiaries that allow Digital Power Lending to lend money. Spyglass Hill Capital Lending Corp. Is raising capital from institutions, family offices, endowments, accredited and non-accredited investors to deploy into a portfolio of loans through DPL and the investment portfolio of DPW Holdings and its subsidiaries. And this is really important because what we have is a unique ability to bring capital in on one arm and then take that money at DPL and go lend it out to various companies that we think are compelling, in the sense that they have plenty of asset coverage. They also have tremendous upside in the event that they execute. DPL is a registered California finance lender. There's the license number. So basically, Spyglass Hill Capital Lending and monthly interest provide a marketplace that enables DPL to offer secured loans to small public and private businesses that is designed to create a much needed alternative to the costly cash advance payday type small business lenders. So as we talked about earlier, what you have is a great opportunity for sub $250,000, sub $500,000 loans that are not being currently met by small businesses. The regulators, the banks they're making it very difficult for small businesses to get capital. We've seen it on Wall Street in a lot of ways where they've really made it prohibitive to put stocks in brokerage accounts. They've made it, FINRA included, very difficult for small businesses to get access to capital. So therein lies a great opportunity for what we're doing at Digital Power Lending. Changes in regulations due to the Jobs Act, which was the first start of trying to open this capital up to small businesses, enable individuals for the first time to participate in compelling investment opportunities that weren't really only offered by institutions and big Wall Street firms. The Main Street to meets Wall Street thesis really is our theme and philosophy and the driver behind what we're doing on the lending arm, particularly with Spyglass Hill Capital Lending, which is a non-bank holding company that owns DPL. We raise capital through Spyglass and monthly interest, and in turn provide opportunities to institutions and individuals to profit from secured loans that DPL lends to companies. So our focus really this year is, as Todd had mentioned, to really try and build our own balance sheet. So at some point we can spin this off. But DPL is focused on building its balance sheet in 2019. We're participating in several syndicates, both on the merchant cash advance side as well as the public side. And what I mean by that is I spent a considerable amount of time building companies on Wall Street, and in doing so developed 20, 25-year relationships with institutions that really like to bring partners that they can trust, people that they think bring value add, in the sense of putting together private placements in the form of PIPEs, which is a private investment in public equities, which you might recall Warren Buffett did when he put his money into Goldman Sachs during the recession of '09, the Great Recession, as well as Gillette and General Electric in the $5 billion transactions that he was doing. When I started the pipe business in the mid-'90s, people really considered them, equipment under a sink. But the reality is that it's become an incredible opportunity for public companies to gather capital. And if it's done properly and the people that are running these companies execute, it's quite profitable business for the investors as well. So we're going to continue to build on an existing network of these sophisticated friends of ours, and we'll allow DPL to fund what we consider the best opportunities on the street in well-managed and compelling growth companies. The team continues to target gains in the 20 to the 50% range, and while our attorneys would say that's not a guarantee, we believe that we've shown that we can do that. We think we're going to continue to do that, and with the right opportunities, we think that we can do that in both the public and the private companies. So our team is led by me. I have spent 30 years on Wall Street. I started with the big firms of Bear Stearns and Lehman Brothers. I was an investment banker. I ran a small boutique company out of San Francisco, an investment banking firm, for 12 years as its CEO. As I mentioned earlier, we don't like to brag, but we were instrumental in starting the pipe business in the mid-'90s. We reached acclaim through a $50 million private placement in a company called Informix in the late '90s. Saved the company a year later, and that pipe enabled them to sell the company to IBM for $1 billion. The investors made an awful lot of money in that. And it kind of jump-started the whole credibility of the pipe space back in the '90s. I've raised billions of dollars. I basically try to leverage my knowledge, which some would question isn't much, but we have an awful lot of experience and we have great reputation and relationships. And we basically try to provide our investors with an opportunity to participate in new transactions that are targeting undervalued companies. I've got a great team around me. They're very supportive. We continue to build with great people, with great integrity. And we see, this Wall Street meets Main Street as a great path to growing this business. We basically like to provide capital in what we consider growth companies. So we're not trying to pick the next startup. We're actually very focused on companies that have revenue that we think are undervalued. On the public side, we like to see liquidity. We can talk about that. We like to have a time horizon of 6 to 9 months. I'll explain one of the transactions we just did. So as we talked about, we got our license, which is not an easy thing to do. It takes a long time. They do a lot of background checks on us. We eventually took this license and got it approved in February of 2018. It was about an 8-month process. Our target on the public side is really, annualized returns that sound crazy but can be done, and we've been doing it in the 50% return area. DPL acquired through its investments a portfolio of 3 to 5 year warrants in public entities. This is a really important factor in the business model because as you make these investments, for example, we recently put an investment in a publicly traded company. Some friends of mine had engineered a turnaround. We put in about $150,000 in a convertible debenture, which was secured against the assets of the company. We made 20% on the investment. We kept 100% warrant coverage. And the reason that is critical is if you assume that you're taking your capital or your equity risk off the table, you basically have a free rider on the upside if the company continues to execute for the next 3 to 5 years.
Billy, let me add to what Billy's saying. What's important about what Billy's doing, you can stay up there, it's fine. What's critical about what he's doing is that, as Billy, the other Bill would say, I get up with these eclectic ideas. As a California lender and our ability to lend in other states, we're able to make loans to public companies, keep a warrant portfolio, but avoid the 40 Act because we're in the business of lending. There's a lot of strategic leverage that people don't understand about digital power lending because as we make a loan but get a carry in that underlying business, we build a portfolio of future assets without any capital really at risk once we get our money returned to us. And more importantly to me, on top of that is we get to get a lot of looks. We get to look at a lot of other public companies and opportunities to where down the road. Now, will tell you we're not allowed to buy anything right now, so it's irrelevant that we're looking at anything because no matter how good of a deal it is, it's not going to happen right now. We got to digest what we have, but you can kind of see that having the loan portfolio and his access to public companies and private companies gives us deal flow and return on our money. Really, the last loan you did was a great loan. It turned out to be great.
Yeah.
And we expect to get a high rate of return on those loans.
Yeah. And just to elaborate a little bit on the warrants, in my 25 years of owning warrants or participating in warrants, they're really remarkable because although one could make a case that says that the majority of them expire worthless, there are several times, as Todd has said, in the iteration of that warrant over 3 to 5 years where that public security moves around. And if there's intrinsic value, we have the ability to take those off at any time that we want it. They're registered. We can exercise them. And with that, it only enhances the returns to DPL and the portfolio. So I think that's important to note. And ultimately, a portfolio of warrants, a basket of those, is pretty compelling on the value proposition at DPL. So with that, we've established brokerage accounts. We've sold stock. This is a difficult thing these days in what we call the microcaps. In our world, let's call it sub 50, sub $100 million market caps. The brokerage community has made it very difficult to book securities. We have the ability to really, book the securities, sell the securities. So I'm very comfortable with our relationships on the street that we're doing that with, which is critical to us, to monetize these gains. We've hired executives to complement the team, bringing relationships and years of experience to enhance these returns. We have deployed over 4 million secured loans. Todd and I have raised, 20, 25 million on top of that internally as well through the last 2.5 years. We've created these online portals, Spyglass Hill Capital Lending and monthlyinterest.com, that'll be key pivots for us going forward, where individuals as well as institutions can invest with the intent of receiving monthly interest on the investment. Thank you very much. Appreciate it.
Good job, Billy.
Thank you.
Billy, let me touch on a minute or two of digital power lending. There's a lot of opportunity in that space, and I think the most important thing to know if you were to look for the future, you were to try to gauge what things happen in the future, what would be some key milestones. One of them are going to be establish relationships with outside syndication. Does digital power lending get access to its own capital, its own balance sheet, without the parent company? That answer is going to be yes. Right now, we're in discussions with a lender where we'll syndicate and have access to around, it's a $200 million portfolio of capital that we'll be able to do in the merchant cash advance space, mainly restaurants, trucking companies, etc. That's a very lucrative space for us with our license. So if you're an investor that likes the lending side of it, look for digital power lending to get bigger over time. We have a lot of plans for that business, but we're gonna take our time and try to do it right. DPW Holdings probably does not put a lot more capital in that space, but digital power lending and Spyglass expand their own balance sheet to match their ability to provide funding. So we think it has a lot of value to us. David Kraus could not be here. He's the CEO, along with his wife, of IM, which is really is a digital power lending story. And that is, I'm going to get into this very quickly, and that is, we lent approximately $1.75 million to the Krauses through their business, A5, to go and acquire the restaurant group, which was Prep Kitchen. We got a 50% equity stake. There was effectively 98%. When the loan gets paid back, they go to 49, we stay at 51. So not only do we get all of our money back for digital power lending making that loan, we get cash flow from the loan, and then we maintain an equity stake long term. So this is a kind of an eclectic transaction that we think will provide long-term upside. That keeping of the 51% equity, and even if we get diluted down, is the sort of icing on the cake. This is the inside of one of the Prep Kitchens. They're very nice. Any of you shareholders who want to go to a Prep Kitchen, they're in San Diego, San Marcos, Little Italy in downtown, La Jolla, and Del Mar. There's 4 locations. I think David would like to expand to 100 if you asked him, but we are not going to provide that capital for that expansion. It first opened in 2009 in San Diego. It has a great reputation. The food is very comfort food. It is part of the DPW family of companies because of that loan. Many people say to me, the heck are you doing owning Prep Kitchen? Run by great operators. It's run by great operators. They are a profitable division of DPW Holdings. I want to say this again. That division makes a profit. Okay, so when everyone asks why I'm in the restaurant space, they make a profit. Unlike some other divisions that aren't there yet, they make a profit. But we got the holding because of the loan. I happen to have experience in the restaurant space, so I was very comfortable making that large loan. I think Billy was a little more gun shy, but I encouraged him. And so we have a big stake in the company, presently 98%. I expect that stake to go down as they pay the loan back. These two run the company. Deborah Kraus came from Cheesecake Factory. She ran Pure Nightclub, second to none in terms of operators. The chef came from Wynn. I'm going to make a forward-looking comment to give people sort of an overview of where we are with this, and that is a little bit of a hidden fact, which is out there in the public, people don't know to really see it, I guess, is that the old Avalanche owns Restaurant Capital Group. We longer term think that Prep Kitchen, Restaurant Capital Group, Julia, and the other portfolio of restaurants that potentially could be roll up into like a restaurant brand thesis, and that the digital power shareholders, the DPW shareholders, end up owning a stake by getting a special dividend. We haven't quite figured out how we'll spin it off, but we are probably in the 80% plus range that a year to 2 years from now or less, that the restaurant group isn't part of DPW Holdings, but we reward shareholders with some form of a dividend in a profit-making venture in the restaurant space. This would be culmination of us getting our money paid back to digital power lending and us monetizing this. This could come sooner rather than later because we're really focused on matching our long-term assets with long-term borrowed capital versus right now we kind of are sideways with upside down a little bit with a lot of borrowed short-term capital with a long-term asset. But believe it or not, we're comfortable with the investment. We're comfortable in the restaurant space there. I realize for a lot of people, meatballs and missiles don't make sense. I know when I'm at board meetings with Amos says to me, let's go meet and have a meatball while we're talking about missiles. So it doesn't. It is what it is. The Pure Nightclub Management Group did about $80 million in revenue. Deborah and David have sort of a long vision of rolling out throughout California. they will need to have access to capital on their own, which is kind of the thesis about some of the portfolio companies that DPW Holdings owns. So I figured this presentation would be short. Does anybody have any questions about the restaurant space? Any of you guys want to talk about the meatballs we serve or anything like that? So this is really strategic. It's really an investment that came about through the lending portfolio. As an entree to this, one of the things that we do in Merchant Cash Advance with Digital Power Lending is lend to restaurants. And they're an important user of that service because they have these peaks and troughs in terms of when they need capital. So I wouldn't be surprised if the restaurant space grew as a total part of our portfolio, but through the advent of loans and transactions on the Merchant Cash Advance side. I can't tell you enough how we like the business, we like the people that are running it, but we are keenly aware of deployed capital and where we can put it. And I think as Will and his team, David and Ken, go through this migration of what makes the most sense for deployed capital, it probably makes the most sense for Restaurant Capital Group to ultimately, and Restaurant Capital Group and IM, and the group of restaurant investments to be spun out. And that probably happens, in a perfect world, it happens this year. One of the things that Will is emphasizing to me about our transactions is that we focus on some of the ones that really are low-hanging fruit for us right now. And so it's probably a later stage. Wouldn't you think a later stage opportunity?
I would.
Right. You want to speak about this at all?
You got it.
Did I cover that?
You've got IM covered.
I got it. Okay. Any questions about IM? You sure, Darren? You want to talk about pasta or something? Okay. Like I said, if you're in San Diego, you should try the restaurants. They're wonderful, and they are producing money. And if you're a DPW shareholder, I would go try it out because this is the one area that's making you money right now. So this brings up a little controversy for me. During the glory days of 2000 and was it 17? Bill, was it 17 or 18? Yeah. What? Right. During the glory days of Bitcoin's rally, I thought, well, it's going to be important to take some of that cash and continue to diversify the portfolio just in case something happens to Bitcoin. I don't know that thesis was correct. In fact, I could argue that it was incorrect. In fact, Bill used to call me every day and say, "You're a Bitcoin company. Stop talking about that other stuff. You're a Bitcoin company." We made a commitment. We have I think we deployed about $2 million of capital into the hotel as part of a $156 million package for the hotel. They have lined up a big, really well-known investment bank who's provided them $85 million of construction loan capital. McTaggart's, the Caspies are involved. We're a bit player here, but we like the investment. We were putting in about $500,000 a month. They have been nice enough to let us reduce that commitment to right now zero. We still have the ability to put an additional $18 million in. I love the space and I want to be there, but this is a question of deployed capital. So from a disciplinary standpoint, we're no longer putting DPW Holdings money into that investment. And to the extent it gets sold, we are a small player in their investment, their capital stack. So they'll probably have a conversation as to whether they want us to stay or not. The hotel is underway, though, and if any of you have an opportunity to see it, it's really remarkable. It's down in Tribeca. It's not too far from here. It's under construction and has been under construction for quite some time. It doesn't mean we won't seek additional capital through private partnerships. I can see one of the persons in the background who actually gave me some of the money to make this investment. Probably going to chuckle about that, but it's something I really like. Let's go to the next slide. They're going to have a really well-known brand running them, a brand out of Europe that is trying to break into the United States. A private club, restaurants, pool up top. It's really a a beautiful place run and being built by hotel owners in New York City. I hope that things change and we're able to expand our position, but right now I don't see DPW Holdings or its subsidiaries putting in more capital directly into the hotel. I think that given the market cap of the company and the size of what we wanted to make the investment, we've had to reduce that. I don't think that's a unknown to anybody here in the room or online. Can you give me the next slide? It's located in Tribeca. I'm not going to say the name out loud, but you can see the name of the hotel up there. If those of you have been to Europe, it's a very famous name, and they bring it's going to be 5-star all the way. There'll be a time and place when you're a DPW shareholder, you're going to get a deal to be there, and we expect it to open in the I think the winter of 2020. Here's some renderings of the lobby. A typical guest room. The bar. I think there's 3 bars. So on a $60 million balance sheet or plus, give or take, it's about $2 million of our equity. And if something changes there, we'll let the marketplace know. We made that investment at a time where we thought we'd raise a lot more capital, and access to capital would be easier. So we'll have comments about the financial engineering at the end. Any questions about the hotel? Alan?
Yeah, thanks, Tom. Given that, the investment is where it's at today, the intent was to be larger, is there, if you had a desire to get it off the balance sheet, do you think there's a market there potentially, to sell this $2 million piece, and get the cash back on the balance sheet?
So the cash back on the balance sheet is a good question. So we have been in conversations with a general partner who has, how do I say this carefully? We've had high-level discussions about us being bought out as a partner. I'm resistant to that, as you know. I would prefer to keep the investment. But recently we've had some illiquidity, and it's an interesting dialogue, Alan. If you guys don't know that Alan's one of our lenders and a very good lender, and helped us helped us make the investment. Deployment of capital is critical now. The decisions are more important than ever because the balance sheet's getting bigger, and some of the subsidiaries have really amazing opportunities, and so you have to figure out where the best use of the capital is. You could make an argument that the best use of the capital is not in that hotel. So therefore, that would be a mistake of allocation of capital, which I have made several and will continue to make new ones. Hopefully it's not the same ones. Any commentary there?
I'll save it for the end.
Okay. Any other question? Alan, the answer to your question is that we're in active discussions to figure out something there. But I don't have anything to report at this time. This is one of my favorite people we're going to bring up. Can't say Darren McGough because we went to college together, so he's a favorite person. But I love this Marty guy. Marty comes from Digital Farms. He's a really interesting guy from Indianapolis. I had the privilege of going to the Indianapolis 500 last year in 185-degree weather, and I don't know that I'm exaggerating. It was truly the hottest place in the universe I've ever been to. Marty has a lot of experience in the data center space, and I hope I'm not getting this wrong, was part of a $1 billion REIT. Really a smart guy, a CPA, a real estate expert. Sometimes we get a little serendipity. We met him through Bitcoin, and now we're in the data center space with him. This is a committed asset. We've talked about spinning this off to shareholders in 2019. Let me give you a really quick update. We are going to spin this off to shareholders. The amount we're going to spin off, we don't know. There is a Form 10 ready. We haven't filed it. The audit will be complete in April. Once the audit's complete, we'll file the Form 10. We do not know how much we're going to dividend out to shareholders, but if you're a shareholder of DPW, you are going to get shares of Digital Farms. That is our plan. That is our intention. DPW will hold back some of them because we like to retain some of our investment. But I love this company. This is the former Super Crypto. Without me babbling on, here's Darren McGough, the CEO of Digital Farms. We have David Katzoff, the CFO, in the audience, and Marty Schrader. Thanks.
Thank you, Todd. Good morning. As Todd said, I'm Darren McGough. I'm the CEO of Digital Farms, Inc. You knew us as Super Crypto Mining in 2017, 2018. And we're a company of DPW, more specifically a division of DPW Financial Group. And we have 15 minutes together today, so I'm just going to take some of that time to talk about when we were formed, how we were formed, the purpose behind that, how we evolved in 2018, and then we're going to get into, spend most of our time on where we are now and our vision for 2019 and beyond. I wanted to start by just asking for a raise of hands of how many people in the audience have invested in cryptocurrency, familiar with Bitcoin, or involved in that at all in the last 2 or 3 years. All right, perfect. So this will be a relatable topic to most of us. It'll be a fun conversation. Talk a little bit about the evolution. So in 2017, DPW, the parent company, made significant investments in mining rigs to the tune of millions of dollars. In 2017, late 2017, I was asked to help kind of support the team and make sure that those investments were managed closely, that we leveraged every opportunity we could within the crypto space, and that there were no rocks unturned. So in early 2018, we formed the company Super Crypto Mining. We put a team behind that, and we started to look for locations where we could place our miners. Locations across the world, really. We focused in California at first, so we become familiar with the process. We got to understand the space. We got to realize quickly that data centers were trying to support crypto mining, but really weren't set up to do that. Machines run very hot. They take a unique setup, so it's tough to run those in an internal system. We were able to connect with some partners as we were networking that helped to guide us. 2 of those folks are here today. Helped guide us to a facility in Indiana that we did our own build out, and we were able to set that up with hot and cold aisles and run the machines the way we wanted to at a low cost for energy and a large capacity for energy. We set the goal to have over 10,000 miners by the end of 2018, which at that time was a realistic goal because Bitcoin pricing was dancing around $19,000, $20,000. It was easy to raise capital, to buy machines and deploy those machines. The company leveraged relationships that we had with sister company Cool Assist. They're in the power business. You're going to hear from them today. Understand that they had a power supply that served the crypto space. And so we leveraged that, and also supporting blockchain equipment. So we set up a division that would operate to the consumer market and sell retail, both the power supply through Super Crypto at the time, and then we also leveraged the relationships in China to be able to create our own miner. Anya, thank you. And so we offered that through a retail channel. And then we had a lot of people inquire about how they could get involved with mining. And so we did a small cloud mining offering to curtail some of our energy that we were using, some of the power from our machines, and make those available for a small investment. And people could use that to experience crypto mining. Now, in 2018, crypto started to crash. And so we had to evolve as an organization. And we did that by searching out low-cost power, rechanging our focus and evolving as a company. And we realized after purchasing a dam in New York that the person that controls power at an inexpensive cost is really king. And so that is our focus for 2019. We want to be able to have real assets, real estate, facilities. We want to be able to support large computing. So we've begun to seek out low-cost power, large capacity, low-cost power. We want to own that asset in 2019 and beyond. And we want to do that in a couple ways. We want to leverage strong partners and experts in the field. And we're going to introduce 2 of those folks today to talk about a specific target that we're working on now. As Todd had mentioned, we're going to close on that probably next month. We're also making moves with our current relationships that we had established in 2018. We're exiting those agreements, and we're moving our miners to our least cost power, right now in Indiana, eventually in Michigan. Machines are still running. We're monitoring those closely. We have about 3,000 miners, so short of our 10,000, but it was a smart investment or a smart decision not to keep investing in equipment, especially because of the changing markets. And we turn those machines on and off depending on the difficulty level of the mining, the price of Bitcoin, and of course our power costs. So we'll be shifting our machines and continue to exit out of the current relationships. But we'll remain positioned if the market changes to turn those machines all on, to even buy more machines. We've really learned a lot about this space and we become experts in many areas. So we can turn back on cloud mining, we can add more equipment, but we really want to be positioned to be able to help people execute on their plans with machines as well, with real assets. We want to be positioned also to focus on mainstream blockchain. Blockchain's here to stay. We want to have high computing, a lot of power, and the ability to support things like artificial intelligence, with autonomous vehicles, rendering farms, anything that takes a lot of computing power. And that's really where we've positioned ourselves today. We have an exciting opportunity with Digital Farms Management LLC. We have two gentlemen here, Marty Schrader, Jay Looney, who are helping us. They've helped identify our first location where we're going to move our miners and operate them. It's a large facility and it's an exciting opportunity. So we wanted to invite Marty to come in today, and this is Marty Schrader. I'm going to invite him to come up and talk a little bit about this first real estate asset, how we're going to position it within the Digital Farms company, how we're going to leverage our current assets, but also create an opportunity for us to do more.
I do want to add something to Darren. I've already up there, and I just want to add something real quick. One of the things, there's a lot of people, you've heard Buffett's comments about heirs of omission, heirs of emission. We set out to buy 10,000 miners, install 10,000 miners. Probably the greatest unknown decision was Darren being in my office every day saying, stop buying miners. We're going to get killed, right? People don't realize, they think, well, you failed, you didn't get to 10,000 miners. I can tell you that if we would have bought the other 7,000 miners, we would have went bankrupt. The cost of those miners was so high, and the precipitous decline of the value of those miners was so severe that not being able to complete that last 7,000. And in fact, some people have seen that we have a dispute with one of our creditors over it. It was probably the single decision that allows us to stay in business today, because we were going to deploy a lot of capital to this space. We put about $10 million in this space, and we're still here and alive, and I can tell you a lot of others are not going to be there. So Darren's decision to beat me up every day about this probably is something that has not been really testified to in terms of people understanding that single decision allows us to fight another day. We still believe in Bitcoin mining. We still want to be there in that space. We will deploy, but a little smarter than last time. Go ahead, Marty.
Sure. So thanks everybody for being here online and in person. When Jay and I first met Darren and Todd and Crypto Joe, it was in the form of a vendor. We arranged for their immediate needs to deploy about 3 megawatts of power in under 60 days. And it was a pretty amazing process, actually. But in the midst of all that, Jay and I looked at the fact that the existing facility in Indiana that we deployed them into wasn't going to be sustainable for their growth. And if they'd have gone to 10,000 miners, we would have had to have found more sites, more cost-effective, more geographically diverse and whatnot. So we immediately started looking at opportunities. Jay's been in the data center business for over 20 years. I've been in the commercial real estate business and for over 25 years, and Jay and I have been partners in deals for over 10 years. And we started thinking about the future, knowing that we wanted to get back into the data center ownership business. And we kind of sought out a first opportunity. It is in Michigan, as everybody mentioned, and we had a handful of criteria that we really wanted to focus on. The Bitcoin and mining operations are interesting, but they're only a part of the story. We didn't want to develop a business that was reliant on Bitcoin or mining or anything else. We wanted to be able to accommodate it but more importantly, survive without it, which brought us to this first facility, whose key characteristic is very affordable power costs. The second key characteristic is we view it as a three-legged stool. It's a 600,000 square foot building. It's on 35 acres of ground. It's got enormous power capacity already built to the facility. It has enormous natural gas capacity for cogeneration. As Jay likes to joke, it has a 14-acre roof for solar installations if you wanted to go that direction. And it has positive NOI right off the bat in place today. So the idea behind the facility is we can develop a section of the facility to accommodate DPW, Super Crypto, Digital Farms, mining rigs at cost, basically, at e-cost.
Get a little closer to the mic.
Sure. I'm not a big public speaker.
That's okay. You're great.
So anyway, so we can develop a portion of the facility to allow those miners to be turned on at much lower Bitcoin levels and still be profitable. That's key for Todd and Darren and Joe to be able to be sustainable in that space and utilize the assets they've already bought. In the meantime, we have the ability, because of the power capacity in the space, to develop an enterprise data center. Not a huge one. It's a tertiary site, but that's okay. The world needs tertiary sites, and the world's moving far more towards edge computing. You either have hyperscale, the giant Amazon, Microsoft, Google data centers. Everything else is moving to the edges, where the data is captured, consumed, utilized, etc. So we like that. And then the third leg of the stool is we have a commercial real estate business of nothing more than warehousing, storage, light manufacturing that more than pays for the asset. Any one of the three makes this asset work. Two of them makes it very profitable. All three of them, while providing benefit to Darren and Joe, can make the deal very profitable, in our opinion. We have a great deal of experience in the space. We understand the asset very well. So we're really excited about it. It's going to be a great opportunity. And what we view it as is the first of several opportunities. And actually, when Jay and I leave New York tomorrow, we're headed to the Carolinas to finish putting under contract a enterprise data center that's a sale leaseback to a publicly traded telco. Profitable from day one. Works perfectly fine with just the telco as the only tenant, but the capacity's there to 6 times, Jay? 6 times? What power they're consuming. But the deal works in and of itself with just the sale leaseback. You can see some of the specifics about the facility in Michigan. There's nothing about the Carolina deal in the slide deck, but we've got ample clear heights. It was a former copper manufacturing facility. So it's a 600,000 square foot building. It's fully secured. It's got great ceiling heights. The building's actually in tremendous shape for what it is. We have 3 separate substations owned by the property on premises, which is tremendous. Comes with a private rail spur right off a main line from Detroit to Chicago with an internal 3-car rail dock.
I just picture miners in China putting all their machines in cargo containers and putting them on a train and sending them to us.
Yeah, and one of the plans is after we deploy the first 3 or 4 megawatts for Darren and Joe at cost, the real play in the blockchain space is to lend off of their relationships and bring in other clients that are more profitable for the property itself. That's kind of. So, as you guys are probably mostly well aware, the data is increasing exponentially. The demand for data center space is increasing exponentially, and it's also starting to spread out into multiple locations. There's a thesis out there that we subscribe to that the old model of building tier 3, tier 4, the super secure, impenetrable data center Fort Knoxes of the world is going by the wayside. It's becoming a lot easier and a lot cheaper to deploy multiple lower tier data centers that are redundant than it is to build the Fort Knox of data centers anymore. Speed of communication, resiliency, and those things are driving all that. We're also very interested in some other options that we're starting to look at around autonomous vehicles, artificial intelligence, the high-density compute needs that revolve. Bitcoin mining was a great driver to learn how to handle a lot of those requirements, but the crypto mining, whether or not it ultimately survives, is irrelevant to our business model because we're really in the data and client business. So that's the idea. Questions? Does anybody? Yes, sir.
Okay, so now you have this big facility, the data center on the cutting edge is great. I think that's a great way to go because the blockchain is. I want to understand a little bit more of the blockchain. That's because of the blockchain and everything moving, or is it because of 5G? Why are you?
It's more 5G. Well, as far as the edge computing, what's happening is the amount of data that's being created and has to be captured is so diverse, and the key to it is to capture it and get it into the ground as fast as possible. So what Jay has a theory that what you're going to end up with is ultimately data centers like McDonald's. They're going to be on every other corner. Because that's where the data is being captured, it's where the data is being delivered. It's so scattered that you can't do it from a centralized location as efficiently. So if you're able to get it out on the edges and then into the ground, into the pipe, process it, and right back to where it needs to go, that's kind of the future.
Are they doing that now, or are there other companies doing that now?
Starting to.
Just starting.
Especially with autonomous vehicles.
Yeah.
You haven't had that information scattered everywhere.
Yeah,
Like cell
smart
towers.
cities, and I mean, there's so many different things. It goes so far beyond.
So it's like the data towers. You're going to try to
Exactly.
make a nice name for it. Okay.
Exactly.
And the blockchain is the other question. Where are you? Is the blockchain just for mining, or there's
No,
other ways?
it's going to evolve way beyond that, and there's.
That's what I'm trying to tell you.
I have an analogy that I'm not going to do on a public. I'll share it with you offline.
Okay,
but
good.
the gist of it is, the mining is interesting. It's the first way that somebody figured out how to monetize a really interesting technology. Very similar to the first time you saw a search engine. You weren't in the internet. You weren't really sure exactly how this was going to turn out, but you knew it was really cool. It was really going to be useful, and this was going to stick around. Blockchain is the underlying technology. It's phenomenal. Mining, cryptocurrencies are interesting. They probably have a place in the future, long term, but blockchain will evolve far beyond cryptocurrency in a lot of different ways. For example, there's pilot programs out right now with Walmart and IBM where they're tracking food production literally from the field to the table. They can tell you when you eat some bad salmon and get food poisoning, instead of 5 days to trace back the history of where did this thing probably come from, they can tell you in 4 minutes. It came from that farm, that box, that carrier, that store, that dinner. It's that kind of technology that's disruptive.
So I think the key is that we're diversifying, we're trying to leverage every opportunity, but remain positioned to execute on any changes in the Bitcoin or crypto space.
Thanks, guys.
Thank you.
Appreciate it.
Yep.
Thanks, Marty. Let me go back over Digital Farms for a second. What do we look like on time?
You're okay. You have a couple minutes.
Right. So we acknowledge that we have a Bitcoin-based shareholder base, and we want to be positioned for a surge in Bitcoin. So we will accelerate machine deployment if there's Bitcoin's higher than $4,000. Over the weekend, Bitcoin was at 41.87, and I thought we'd have a glorious rally into this week. But like all things you hope for, you have no control of that. I hope that all the people online and shareholders hear this message. A lot of people are asking me about a reverse split, which we do not want to do, but we may have to. We prefer not to. We think the company's undervalued here. But the New York Stock Exchange has given us till July 4th to fix that. I want to be clear, it's my intention, the company's intention. We believe we can put Digital Farms shares in the hands of DPW Holdings shareholders so that they have the closest thing to a pure play in the data center and Bitcoin mining market. I think what Jay and Marty are doing justifies more than 10 minutes of talk. Jay didn't speak, but if you listen to Jay, I've spent some time with him and had dinners and lunches with him. As you know, I don't miss a meal. And he's walked me through his vision of the data centers he's built in the past and what these micro data centers will look like. Someone's in the audience that I know pretty well who's also into edge computing, and we have relationships with Peter. And so I think that you're going to hear more and more about this, but it's important to note that we want to make sure that the shares of Digital Farms in some capacity are in the hands of DPW Holdings shareholders, and that they're rewarded with those shares so they can participate on a pure play basis in Digital Farms. And I hope everyone gets that message. The next presenter is Amos Cohn, the CEO of Coolassist Technologies, which makes up Enertech, Gresham Power, and Microphase. These businesses have been around a long time. Enertech, 22 years plus. Gresham Power, 60 years plus. Microphase, 62 years plus. They're going through an evolution in terms of their business model. They make up largely defense contracts, but they have recently announced a $5 million medical contract for Enertech with a division of J&J. This business will comprise about, combined with Power Plus Electronics, Digital Power, and Power Plus Distributors, it'll combine for a little bit under $30 million of our revenue for 2019. You could argue there's an opportunity to roll up on a horizontal basis other defense contractors. As I said earlier, I'll keep reminding everybody, we're in pay down debt mode, grow the equity mode, and operate with less leverage going forward. So we're not making any horizontal acquisitions at this time, but it will make sense longer term. If there's one company that could be standalone and that we'd look to make standalone, it would possibly be Coolassist in the defense space. It's not going anywhere. There's long tail contracts. One of the misnomers about some of the businesses we do, and I'll cover it, that is, we are single source suppliers for some of the world's most important jets. I get people online saying there's no way that's possible. Well, you're not doing your research then. We are a single source supplier for some of the most important jets in the world, including the Joint Strike Fighter, the rollout of the F-16, and I'm pretty proud that we own this business. It does need to be right-sized, and we're working hard on that. We expect Coolassist Technologies, that division, to turn profitable in later 2019. Enertech is expected to be profitable this quarter. We believe that Coolassist will start contributing from a economic cash flow basis towards the later part of 19. And with that in mind, I'm going to bring up Amos, who has been with Digital Power and DPW for the better part of 11 years, is a true soldier and a world traveler with offices in England, Israel, Connecticut, and Silicon Valley. Amos.
Thank you so much.
You're welcome.
So good day, everybody.
Amos, talk to the microphone. You're hard to speak.
Hi. Good day, everybody. I'm very happy and pleased to be here with you today. Tell you a little bit about Coolassist, what we do today, and what are the plans for the future. So as you can see, Coolassist is designing and providing technology, mainly focusing on defense and aerospace industry, but we also provide technology and solutions for other disruptive business, including medical, special equipment, and also industrial. We grow our market through special engagement that we have with our customers for a long-term relationship based on the customized solutions that we provide to our customer base. And we look into the different diversified customer and services that we provide that will allow us to be a strong present in the segment that we are serving. Go ahead. We operate as one company. Todd mentioned that we operate in many countries, and I'll show you this later. But we are acting as one company where we leverage the strength that we have in each one of our division to provide comprehensive services to our customer, full scale or entire end-to-end service to our customers. In the segment that we are serving, we provide classified and non-classified solutions. So some of them we cannot talk about it, but because it's a heavy involved with defense application, but some other are more open. And we also provide customized solutions for the medical industry that I mentioned previously. Coolisys is our only owned subsidiary of DPW Holdings. We own 3 companies, Gresham or Digital Power Limited, Enertech Systems, and Microphase Corporation. Please go ahead. Digital Power Limited, we operate under the brand name of Gresham Power. Is a company located in the UK. We mainly focus on defense solutions for the Navy. So it's a naval power system solution. That's what we do there. We also provide services to general purpose in the European market, more acting as a distributor for power solutions. Enertech System is a company located in Israel. They provide defense and aerospace customized solution, turnkey end-to-end solutions to the defense and aerospace. And you can see that some of the product that they provide involved with the missiles launching systems, command and control centers, automated test equipment for mission critical applications. They also developed a unique technology for the medical industry, and we'll cover it later. Microphase Corporation is a Connecticut-based company that provides wide range of frequencies solutions for mainly for fighter jet applications. So there are frequencies, wide range frequency solution, including amplifier, multiplexers, video detector log amplifiers, all deployed in the major jets in worldwide deployment. So we, if we look into the U.S. market, we have our product deployed in the F-16, F-18, F-35, B-1 bomber, the Eurofighter, and some others. Very advanced technology and very critical technology in that segment. I want to talk to you a little bit about our market. So as you can see, 2/3 of our market is the defense and aerospace market. We contribute services and solutions for defense applications such as a UAV, fighter jet airplanes that I mentioned earlier, naval ships, submarines, electronic warfare technology. All this we are covering. So 1/3, the rest of the 1/3 of our business is divided into medical and industrial, where we provide advanced life-saving technology for the medical industry, and we provide a wide range of services and technology for the industrial industry. Darren mentioned earlier that we provided or helped super crypto mining a year ago in the mining business. So Coolisys was under the mission to source the technology helping the crypto mining business to expand. And we are focusing on what we know to do best is to provide advanced power solutions for any type of requirement that is raised by either industrial application or by medical application. This demonstrates some of our customers, not all of our customers. As you can see, we are engaging directly with the government, domestic government as well as international government. We also serve directly the different military branches, domestically as well as worldwide military branches, such as Air Force and some others. We also provide technology to the major and most significant defense OEM worldwide. Boeing, Harris, Lockheed Martin, General Dynamics, L3 Communication, and some other. They are all customers of us. We provide services and technology that integrated into their comprehensive solution that they sell to different defense applications. We also provide, through our UK division, power solution that goes into ship deployment. And we can see different shipyards that are actually being our customer that deploy our technology in their actually defense solution. We can see Daewoo in the east, Helic Navy, which is it is the Greek Navy, and some others. We also provide product and technology, as I mentioned before, to the industrial and the medical market, and we see that Johnson & Johnson is our customer, buy the technology from us. Aries is a very large broadcast technology provider, also a customer of us. Martin is a German company that provides lighting, fixture and lighting services, a customer of us. Akal is a distributor. Elma is another distributor for advanced industrial application. On the left-hand side, on the bottom, Thales is a French company that provide defense services, mainly for airborne and so on. So we operate on three different continents, 3 countries, 3 different continents. Headquartered in the Silicon Valley. Our Shelton facility as well as the Israeli facility. Both provide a solution for the defense and aerospace, where our UK facility provide solution for the Navy. So if you can see this, one support the other, and we, as I mentioned earlier, we operate as one company, and we provide the services that are across the countries and across the continents. I'll talk a little bit about our portfolio. I'm not going to cover too much. So this is this represents our operation in the UK, and we provide the power solutions that are deployed in different destroyer ships and submarines. It includes statistic frequency converters, transformers, helicopter starters, military-grade UPSs, and some other. It's all power stuff that goes into ships. Very unique and very niche. We also provide industrial-grade power supplies to the general markets. Our Connecticut-based company provides wide range of frequency solutions. The products go from a millimeter frequency up to microwave frequency, all the range. In other words, from very low frequency to very high frequency, and that product line cover many type of secure applications. Our facility, our Connecticut-based facility, is a secure facility. We can provide those type of services only if you have a security clearance, and that facility is complied with the government requirements. This shows us some of our product lines. We have 4 main product lines. One is a filter and multiplexers. Second one is a detector log video amplifiers. The third one is a multifunctional assembly, and the fourth one is a detector and switchers. All of them provide the entire range of services that are airborne and require mainly for electronic warfare, missile guidance, and some other radar or high frequencies communications. Another system. It's a leading designer and manufacturer of multi-purpose turnkey electronic systems for military and to provide advanced and specialized technology for the medical market. We provide those launchers for different missiles, and I'll show you a couple of them later. Different type of missiles, mid-range, long-range, ballistic missiles, launchers, command controls, test equipment. Test equipment is very important. As you know, in this business, you cannot waste a missile to test if the launcher is working. You need to have a simulator, you need to test it, and then you know it works. It needs to work in the first time. So simulation and test is critical to the business. For any launcher that our customer is buying from us, they also buy the simulator and the test equipment. This is a great business for us. We provide this type of container. This is a full-scale container. Inside there is a EW power equipment. That is for electronic warfare to protect the surrounding area of miles. Generate a lot of energy, and it's all installed inside, very secure. So this is the main focus of the business, but 20% of what Aeronotech is doing is actually medical, and this is actually show a little bit about our medical product. The medical product is involved with a cardiovascular operation. A physician has a way to improve irregularity of heart conditions by actually using a special catheter that goes into the heart and provide the operations without actually without having opened heart surgery. And what we do, we calibrate those catheters. The catheter need to be very precise, measured, so it will be not affecting or not impact any tissue while they're operating. We do this special calibration. Product line, so we provide complete turnkey solutions from project management, system engineering, development, production, and integration, the whole scale. I want to talk about a little bit about the new initiative and growth, great potential growth. One of them, or the first one, I think it's a very immediate potential growth for us, which is the relationship between Israel and the U.S. on the defense side. The administration approved a bill to support Israel with $38 billion of defense budget just about 2 years ago. All this money has to be spent in the U.S. in order to be available for the government of Israel. That means that technology that are being bought to support the Israeli Defense Forces must be produced in the U.S. What we do as a company who own the Israeli company, we bring into the U.S. the technology, and we will be manufacturing that product in the U.S., leveraging this defense budget that's available for the government of Israel. That will be double the sales of our company, of the Aeronotech. I expect that within the next 2 years, we'll grow the business significantly by acquiring this technology into the U.S. and building the solution that we've already been engaged with our defense customer, leveraging this budget. Likewise, some of our customers that are selling technology in India, and the government of India imposed a requirement that for every sale that you make to India, you have to buy back from India 1/3 of your sale. They don't tell you what you need to buy back, but they need to, whatever they spend, 1/3 of this you actually need to buy from the Indians. So the way to leverage from that relationship between the country, and because of our defense customers selling product in India, we have established a relationship with a local Indian well-known factory to manufacture our product in India. In other words, we will buy their services and will be buy back that 1/3 of the commitment with the Indian government. That again is another growth opportunity for our company. We have invested in advanced test and measurement equipment. That test and measurement equipment is really a disruptive technology that will change the way that engineers and companies who manufacture and produce electronic component and integrated circuit are testing their component and integrated circuits. We have invested already some portion in that technology, meaning we acquire the IP or the access to the technology. With additional investment, we'll be acquire the entire IP portfolio, and we will allow us to produce that technology, which is going to be a chain breaker to the marketplace. We involve in autonomous vehicles. We provide the main power control system to towing tractor or towing vehicles that actually pull airplanes from the gate into the runway. There is an objective by the major airliner to reduce the cost of fueling from the point that they leave the gate, taxi to the runway, and then take off. If you think that there are autonomous vehicles that can actually tow the airplanes from the gate all the way to the runway, and they save maybe 20 minutes of fuel burn, that is a huge of saving to their airliners. And we are involved in providing all the power management to that technology, or it's already been implemented. There is a huge growth in this business. I just want to show you our financial projection for the next 5 years. So this year we are expecting to generate about $26 million combined company. With a new initiative already in next year, we will be reach almost $30 million. Towards the following year will be in a range of 40 million, maybe 39 million, moving to 60 and over 70. That all comes from the new initiatives and the organic growth in the business that we are running. Thank you very much.
Thanks, buddy. Appreciate it. Thank you, buddy. Anybody have any questions for Amos or myself about Coolisis? Dave?
Yeah, how are we looking, I saw the revenues there, how about the profitability? Are we going to see profit in the next 5 years? Or?
So they mentioned that we're expected to be profitable this year.
So let me clarify. Like IM is profitable, we believe in the third or fourth quarter, Coolisis will turn profitable. That business has been right-sized a lot. We've squeezed a lot out of it, and as they leverage some of their backlog. One of the perfect examples of this is something that David Katzoff has just recently done for the company is he's focused on smarter ordering. Prior to us purchasing the company had a certain ordering process where they'd order for a long-tail contract, but a lot of parts to save scale, but then a lot of capital deployed waiting for those to be implemented. He shortened that cycle to more a little bit of a, I'd call it, I'm paraphrasing, a little just-in-time delivery. And so there's a $7.1 million backlog at Microphase alone that we're going to push through as hard as we can in 2019. And David's really focused on exactly what parts we need for that and what deployed inventory we have to have. So we're trying to get better skilled at our internal management of resources. I was watching Amos' presentation, and people don't realize what we do. I still look at the company and go, we make missiles for people, too, missile launchers and testers, and it's remarkable to me where the company trades. But that's what makes a market, right? Go ahead.
I've got 1 minute video if you want to show, if we have the time for that.
Is it possible to play it?
We're tight, but I
Yeah, let's play it. Almost wants us to play a 1 minute video. Looks like we blow things up. It really is. I've been to Israel twice and got to tour IAI, our largest customer, and we do really help them make remarkable products. We're going to go on to Power Plus Electronics. Russ Woodmansee is the CEO, works with Amos very closely. This is under the Digital Power Technology Group. Digital Power Plus Electronics is made up of Digital Power Corp, which has been around for 50 plus years, the old name of the public company, and Power Plus Electronics Distributor is a company we bought last year. Russ joins us from EMC. He's a gentleman, and he's helping build out something that I'm really fond of, which is Power Plus Electronics as a distributor of electronic in the power supply space. It's a really big addressable market. While the margins are a little lower, the ability for distribution is larger. It becomes a much larger opportunity for us. And with that, Russ Woodmansee.
Thanks, Don. Thank you. I've never been called a gentleman from my wife or anybody. Okay, so it's good to be here. Thank you very much. I'm real pleased to be with the company. I've been here for 1 year, as Todd mentioned, or just recently almost hired me on, and I spent 2018, a long time, a lot of energies looking at the 5 subsidiaries of the Koulissis family. And since recently, we've simplified the organization at the holding company. Oh, I have a little animation, so I'll have to figure out a cue to Crypto Joe. Thanks. So Power Plus is the accumulation of the Power Plus Technical Distributor Unit and the Digital Power North America. Next slide. So our vision is very, very, very classic and tried and very well tested and with great results. It's customer focus. We've got to have high customer satisfaction for differentiation. The same for this customer service and support. I'm on the commercial side, but no less, and involved in a variety of industries and products placed into different applications. Defense applications, medical applications, these are life-saving or life-threatening, whatever, but the point is that they're very critical and must work. So we've got to be on the quality and the customer satisfaction angle, number one. We have a very highly trained staff of folks in the power industry. DPC, Digital Power, was founded in 1969. And actually, I think we have one employee, if we don't, most of that time since has been with us. So it's pretty nice. It's a tight family of people. We've got over 200 active customers. We're focusing in these 4 areas: market areas, extreme environmental, medical, transportation, modular, and the high power applications of modular power. Almost 20 of our customers are buying at a clip of $100,000 or more annually, some much more. Our top 7 customers contribute about 2/3 of our annual revenue. Currently, right now, the product catalog that we have is over 1,400 different products, configurations of products. That's probably across 8 or 9 product families from great manufacturers and designers of the world, including Digital Power. The Digital Power brand is a family of product that we're very proud of, and it plays a center role going forward. We also represent a line card or a distribution card of manufacturers of 80 to 100 different manufacturers of a variety of power electronics parts. And so this is the highlights. Our gross margins for about 2/3 of the revenue is at 42%. 7 customers? Well, that's interesting. Okay, so 2/3 and 2/3, but those are accurate. So we're about 42% gross margin across 2/3 of our revenue. Next slide, please. So customer products on the distribution side, we have a variety of, power-related products that I mentioned. Power supplies that are on rails, that are configurable, accessories for power systems and power solutions. As you can see, fan blowers, external power supplies. We take them for granted, but they actually take a little bit of energy to put together, and they're very important for our mission-critical applications. External power supplies look like Dell power supplies, but they're a little bit more important, those applications. Next slide. And then the power electronics value-add solutions that we do are a little bit larger in scale, but we have telco products. What's interesting is I have 2 units. I've got the Fremont-based system, a Fremont-based office, where we do a lot of our high volume transactions coming out of low-cost regions in Asia-Pac, come to Fremont. We warehouse and then we fulfill. We direct order fulfill. And our other unit, 3 hours east of Fremont, in the gold mining, the old gold rush area of California, in Sonora, we have a value-added and a design group there that actually produces and designs these products. And it's interesting, they're the ones with that 80 to 100 product line card. And they were self-feeding themselves. They were establishing alliances with distribution with different manufacturers in order to be able to select the best products and components to create their own designs. And so the place in Sonora, they actually do very quick turn, rapid prototypes, and they're able to take product that they have in stock or that they have within a day or two, put together prototypes and manufacture solutions for people. There are a lot of customers in Silicon Valley that the Sonora office has a great reputation for supporting. And time to market is everything still in Silicon Valley. So it's a great advantage that we have to have that capability. We work with factories, and we have to mandate and make sure that we're having factories that are fully UL TUV certified. We have to keep that in order, and that takes effort on our part. We are dealing with the latest certifications for our sales network is basic here and helpful and very, it's actually just fine for right now. We have the North American sales is handled by an inside and outside sales team that work for me. The EU distribution channel, we're leaning out and working, aligning with Amos on the Gresham Commercial Power side of his UK office. And we also extend our reach, and we're starting to work more closely with a couple of manufacturer electronic rep companies, Tritech and Pinnacle. Next slide. And so to wrap up kind of a real just quick summary of the companies that I'm running here is that we have strategic partners. We have a very, very strong relationship with a manufacturer in China called Teamwise. We have a long-term partner and close relationship with Advice Electronics. They're a great outfit. They do similar things to what I'm trying to do, and they're based out of Israel. But they've got some great products that we use and that we work together to design in for our customers. And we're hoping to get some more traction with that product family as one of our product families that we can lean on. We're really very happy with Advice Electronics. Other names that you may or may not recognize, Akbel, Arch, EDAC, or Taiwanese product designers and manufacturers. EOS is an Indian company, and we're starting to look at strengthening that relationship. And lastly, in terms of partnerships and other things that we're involved in, we're very, very strong in our supply chain globally. We move a lot of product around and to customers, and we directly fulfill. So we want to be able to and have been supporting Phil Mansour's company, MTIX International, with regard to planning for fulfillment. We're actually working on ideas for cost reduction and want to be able to facilitate his ramp for production. And again, the MTIX, that's an interesting one, but it's made of a bunch of power parts and power electronics, and we really think we're very familiar with that, and the factories and the way the supply chain is built. I've already been intimate with that, and we feel very, very, very lucky to be able to work with MTIX in the near future on that at that level. Next slide. Just a recent high-level timeline. I mean, we're coming from being acquired in 2017. This is Power Plus Technical Distributors, the Sonora outfit. Last year was a lot of time, myself coming up to speed, but also consolidation and dealing with the realities of integration. You can have 5 separate companies, but we were looking to try to find opportunities for efficiencies and normalizing processes that might be good for everybody, but some processes might not. But be able to find that gold is what we were doing in 2018, and coming up with the strategies about what we're going to do now and go forward. 2019 ahead of us is right-sizing the business. We've done some work to that level already last month. We're stabilizing sales performance, and the big one is we're going to overhaul this something called the distributor model, which I'll talk about, and launch Power Plus Electronics formally. This is probably the biggest event with regard to the new idea that this is Power Plus Electronics.
And the best part of it, too, by the way.
Oh, well, thank you.
Sorry, I'm very biased towards this idea.
Next slide, please. So this is some of the work we did last year, and again, it's back to, in my role as COO for Amos, was looking at, for example, upgrading our ERP system such that it can support a corporate or an enterprise implementation, and it might be an appropriate path at the right time for certain early stage businesses that we have in the holding company that we can utilize a common platform. There's a lot of similar things. I think also, yeah, we were very, very good. Almost asked me to start. When I came on board in February, we got busy right away and started looking at strategies to support the super crypto mining initiatives at the time a year ago. Not to bring up the bad word, but the Bitcoin and the blockchain. But blockchain is really stable, super great technology. That's there. And so what we did is we created a strategy for a family of power products that need to be managing electricity very well and in a very highly efficient manner. And so Amos and I put together the strategy to go and design a family of power supplies and start with a building block of a stand-up alone power supply, but then be able to take that schematic and all the energy and the development, because we forward designed higher level products, and what I'll say a higher level, like a telco grade power supply that's hot swappable, that's got the reliability numbers of the 5 nines that telco needs. If we did that, and it was also designed to just properly support blockchain, because that is going to be all around us in what we do, I think that'd be a great element to add to a data center. And so we kicked off a development team, and some process and some weekly approach, and we're starting to map ourselves and design this technology. We're probably around 75% ready or done, and we have to decide now to take it to that next level, to the telecom power shelf, and that's something we'll be doing this year, we hope. Next slide. There were some challenges, and there are challenges, the choppiness of our revenue, and we've had a lot of leadership changes. We've got a fairly young sales group. So it's a thought, it's an internal thought. Are we trying to be everything to everybody? What's going on here? But I think trying to solve this is also one of the fun things we're going to do this year in 2019. So here's this, so you can click the button. There's some animation here. What I'm trying to show is the cyclic nature of a bid to contract type revenue flow. There's a long pre-sale, energy goes in to sell that contract. Once you've got it, you could be 9 to 18 months in before you've even placed any orders with your manufacturers, and you've got revenue flowing back for deployments. But if you have a bunch of projects and a bunch of wins like that, this cycle is going to be small. The peak to peak will shrink. But I think what's happened with us is we've found some of our contracts and our customer engagements were waning, and we're finding that this peak to peak is spreading out on us. And it's dangerous because, look, if this is a break-even expense line, I'm having to pay that out of my reserves to be able to get through over time. If this line drops or this thing spreads out, this is really a dangerous situation, and I think that's something that we want to address. Hey, thanks. It worked. Notice this little thin piece down at the bottom. We call it book and ship. This is an ongoing weekly accommodation that we kind of just say, hey, we're going to get about that much unplanned call-in orders. It's about $1 million. It's north of $1 million a year, and we really don't do much to this. Oh yeah, and that's how bad, right, that can get. So the book and ship, we don't really do much to make that happen. It's legacy. It's our reputation. It's taken decades to earn that. But we're really not doing anything with it. We'd like to. So next slide, please. And this is just, I would like to get that. Oh, okay. And this is how we're going to do it. We're going to focus on distribution and turn that into a scalable distribution model. A book and ship. Oh yeah, it comes in. We get about $30,000, $20,000 a week. Just comes in naturally. We'd like to put that on steroids and make something of it, and purpose build this revenue stream. Because I would like to see that little green sliver. If you go to the next slide, I'd like to see that green. See if we can animate that up. I'd like to just lift that up and prop us up on top of something so that my bob and weave cycles are all gravy, icing. And plus, this is high margin, typically higher margin, higher markup. So this is simply our approach. Is that we believe that we need to invest in the distribution model. I've got great moral support with Todd in his belief in it. Next slide.
2 minutes rest.
Thanks. So it's really about digitizing something that we don't have yet that's more analog. We have separate systems, product selector, a website, and an ERP system to run my manufacturing supply chain. I need to digitize that. I need to link and automate these together. I need to tie in a marketing plan so that I can drive my distribution business into a fast tempo, turn those inventories, speed them up, and be able to ship in like next day. I came from EMC where we were shipping hyper-converged racks. We did them in about 2.5 hours. Where it comes in, we had it all just nailed. So it's possible to do better than what we do now. And if this is a robust engine being driven with leads and online technology, we're going to get leads into the value add business as well from this. We'd get maybe 1 a month now. We'd probably get up to 5 to 10 once this thing's rolling. And then the value add business is going to be a benefit from that as well. These blue arrows is just trying to say customer comes in, boom, they got their product. This is a little bit of a longer deal because there's a design and a sell-in that has to happen before you can get those products out. So the key to this is our online, we're going to have to online market and work this engine once we build it, and we need to be involved, hands involved on the analytics. Next slide. In order to understand if it's working or not. So this is a lot of detail. This is the value add revenue stream, and this is the DISTI right now. And here we are. This is just kind of what's been happening on its own course. Right about this time frame, we start investing. You don't see it too much, but there is a lift, and this is an inflection point in this time frame where we'll start to pay back maybe $150,000, $200,000 investment into that distribution model and the ads and the spend. We'll be paying that. That'll pay for itself in less than a year. And then we're really looking, and we're already seeing bookings come up. Bookings right now increased 40% for the third quarter of 2019. So we're already seeing an improvement because we started to adopt a more targeted, less is more strategy on the value add. And you can see this is more steeply rising. But this is going to come for the investment for the distribution model, and then it's really going to be able to scale for us next year. Next slide. So the power electronics industry is anywhere at 20 to $34 billion. I mean, I don't know. It depends on what reports you're reading. But in 5 years, we'll be up, driven by transportation sector and the autonomous vehicles and IoT. We'll be driving that up to somewhere close to $50 billion by 2023. So there's a lot of room for us. We're right about in this space here. And I'm expecting the outlook to be in 2019 north of 7, and the next year we're ranging 10 to 12, and by 2025 I see no problem in being able to put ourselves in this range, in the 25 to 50 million as a business, as a going concern. Next. Okay. And that's just kind of a break-even analysis, so you can look at that offline. But it says right here, 2019. That's where we need to be in order to be a path to profitability. I think there's just one more slide. And so, again, purpose-built digital marketing platform for distribution. And there are some infrastructure in there that we need to hook up. We need to digitize that. It's right now quite manual and unconnected. Sales strategy and the product management course correction, less is more. This is very important. We have 1,400 products, I think I said. We probably should have about 800 or 900, and we should be targeting where we're going, and that's what we're doing right now. So we'll be doing re-engagement programs with legacy customers. I think we've lost a few, and we're going to go back and see if we can get back into the next design cycle with them. This is just the standard stuff, and we're going to continue to focus on the operational efficiencies and wherever we can for the whole holding company. I think that's it. If there are any questions.
Thanks, Russ. Good job, buddy. Thank you. All right. Thank you. Could you go back 3 slides?
Yeah.
So this is something that I discussed with Amos when I first got involved, and he's you were to pretend like there was nothing else in all of DPW Holdings. One of the reasons I'm excited about this is Amos over 10 years has developed really just amazing manufacturing relationships overseas and in India and China. Now, we experienced like Armageddon in December. I don't know if you guys, it was not only the market going down, but Trump and Chinese sanctions and people, the tariffs are an issue for us. So I'd argue like December was just a kind of a quasi. It was really a bad month for not only the market but for people who did business overseas. But what was evident about that is the relationships that Amos and now Russ have in India and other opportunities. The Digital Power brand has been around for 50 years and is an approved vendor with the Raytheons of the world, a lot of defense contractors around the world and in the United States. And this number is terrible, but really manageable. And the difference between here and here seems like a lot, but it's not that big of a tweak to capture some of that market. So I have a thesis, and wrong or right, we're going down the road of expanding under the Power Plus Electronics brand name with Digital Power as a manufactured product of ours. We're going to keep that product name as a product we distribute. But I really believe that long term, that Coolisys, separate from this but part of the technology group, that this particular business from a distribution model gets to be a lot bigger. And it doesn't take a lot for that to happen, especially with the relationships we have. So, almost mentioned to me, you never want a competitor to listen to what I'm about to say, but we had some really big wins at one time. One time, almost won the contract to build the power supplies for the Xbox. Well, needless to say, Microsoft figured out that we were an $8 million company. That contract went away pretty quickly after we won it. But with scale comes opportunity here. And so Russ coming over from EMC, almost recruiting him. I'm very excited about this business. I think that this business alone is worth more than what we have in the entire market cap of DPW. And so I look for this business to add it to revenue in 19 and beyond. It's going to take a little bit of time to build that distribution model out, but I'm pretty excited about this, and I want to compete with. Is that true? Allied's only 500 million. Seems like they'd be bigger, right? But I'd like to see us compete with Sager and TRC. I think TRC is kind of the low-hanging fruit for us in terms of being a competitor with them, and then from there. We'll get aggressive in this space. I really like this opportunity. So thanks a lot, Russ. This is the other bet category. Will and I have had success in the other bet category. Let's switch over real quickly to Karen. Let's so I can explain this for a second. We're going to cover Sandstone Diagnostics, Alzamend, and MTX International Avalanche. All of these, they're not consolidated. They're outside investments in our portfolio. Sandstone, we own about 4.5% of the company. Karen is a rock star in diagnostics with Roche and her background. Small team doing disruptive stuff. And we made about $1 million investment in Sandstone about a year and some change ago. We like being involved with Karen. You don't know what's going to evolve from her. She is an entrepreneur in Silicon Valley in the diagnostic space, has sold to other companies, and we expect to see her deliver on some iteration of what happens with Sandstone. This portion of it is when we categorize the opportunities in DPW Technology Group, DPW Financial Group. This is our non-operating segment, but fairly exciting. With that, hopefully this works out with Karen online. Karen?
Thank you so much. I appreciate the introduction and the opportunity to present remotely here from Silicon Valley. So delighted to talk to you about Sandstone Diagnostics. Next slide, please. The company is a spin-out from Sandia National Labs. The two technical founders were working originally on biodefense applications and working to develop a portable platform in the event of a bioterrorism scare so that we could quickly triage plants and soil and people and crops. So the founders realized that the technology had the ability to impact human health directly, spun out the technology, and we've been building the team. So as Todd said, we have a small team. We're based in Pleasanton, California, just east of San Francisco. The platform that we have, this what we call centrofluidics, uses centrifugal force to move samples around on microfluidic chips, micro, mesofluidic, depending on how much sample we're using. And the platform is incredibly powerful. We have 24 patents filed, 10 of which have already issued. We're going to talk about 2 applications today, but there are many, many other applications of this technology in the area of not only human health, but animal health and even industrial applications. We are at early commercial stage. Our first product is on the market and expecting our next product to come to market in a light way this year and with a large launch next year. Very exciting times for us. Next, please. Our first product, which commercializes this centrofluidic technology, is going to be very different from what you've heard about this morning. This is a home male fertility test. So we have an FDA-cleared testing system, the first of its kind, that allows men to test at home to look at their fertility status. It's also CLIA-waived. We have a centrifuge, which is thought of as a high-complexity instrument. We have a centrifuge that's been simplified to the point where it can be used by a lay user with no training at home, which is pretty exciting. Really opens up other opportunities for us. We are manufacturing at scale. That's part of what we wanted to show with this first product. These microfluidic chips can be tricky to manufacture, and we're able to manufacture them not only in volume, but at very low cost. We launched to the market in the middle part of 2017, and the product is available on Amazon, so it's about as direct to consumer as you could get. We're going through our ISO and CE audit next week, actually, and hoping to be cleared by the summer or the fall. And we're seeing tremendous interest, not only from the US market, but from international partners as well. Next slide, please. We have 2 separate FDA clearances on the product, one for measuring sperm concentration and one for semen volume. These are independent metrics that affect a man's ability to get his partner pregnant. So with our microfluidic chip, we're able to show where men fall in terms of sperm concentration by using centrifugal force to separate out sperm from semen. And it reads just like a thermometer. You can see a white line in the middle of what we call the prop. The height of the line is a compact, it's a cell pellet. It's the sperm cells that have been separated out using centrifugal force. And the height of that line, again, read just like an analog thermometer, tells men where they fall. The separate FDA cleared device that also allows men to measure semen volume and diagnose low semen volume, which is an indication of other medical issues. What's especially exciting, though, is that through our digital health platform, we can identify risks in men's life, in their health and in their lifestyle that could be impacting their fertility and make it a closed-loop system. So we can make personalized recommendations to help men improve their fertility status. They can come back and retest, and we're seeing tremendous results with couples in many cases have been trying for years to conceive, use the track system, see improvements on the male fertility side of the equation, and see tremendous, they get pregnant. That's the best outcome. We're seeing healthy babies that are born as a result of this. Next, please. As part of our work in partnering, we're reconfiguring the product to have a more compact size and actually a package that can accommodate 2, 4, or 6 tests. Gives us a lot of flexibility. You can see here a printed paper sleeve goes over the box, and this allows us to get into co-branding, multiple language packaging, is really setting us up for the partnering that we'll be using to drive this product. So while we're bringing this product to market, we were starting to see tremendous influx of interest from lab and diagnostic companies in this centrifuge. It is unique to have a centrifuge that can fit in the palm of your hand and is as powerful as a lab centrifuge. Just opens up so many opportunities. We started hearing from companies that there were other needs in the market, and we decided we would respond to those. So next slide, please. The next product that we're bringing to market will help transform the personalized diagnostic market, a much broader indication than the male fertility area. And this will apply to areas such as liquid biopsy, which is identifying and measuring cancer cells that are circulating in blood as part of cancer therapy, infectious disease, trying to identify infectious disease early based on DNA signatures, moving testing to the point of care, which could be in physician's office or even at home, and actually at-home sampling, where you don't have to go into a lab and have a phlebotomist pull a whole tube of blood. And what we've seen in talking with companies working in all these areas is that it's not the advanced analytical techniques, the sequencing technology. These are not the limitations in getting the most out of these exciting new areas of diagnostics. The problem is sample quality. So talking with lab directors, they uniformly tell us when you collect blood into a tube, which is how it's collected now, the blood cells stay in the tube until the tube gets into the lab for centrifugation. And having the blood cells there breaking down is, as you can see here, the kiss of death for the tests. It compromises quality and limits what you're able to detect in a tube of blood. Next, please. And this market really hasn't changed. Centrifuges are literally the same devices. They've got electronics in different housings, but they're the same devices that have been used for well over 100 years. So this is an antiquated part of the market. Because centrifuges are big and bulky and fussy, they are placed into central labs as opposed to being distributed, which means that samples have to take a while to get from the patient to the lab, and they degrade all the while. And that's the problem we're trying to solve with our next market offering. Next slide, please. So we've developed the zero delay separation system. And because we're able to bring the centrifuge right to the patient, we can do separation of cells from plasma in any location right at the point of blood draw. And this gives you the highest quality, pure plasma. We're replacing blood collection tubes. And blood collection tubes, that whole market is about a $15 billion market, dominated by Becton Dickinson, who owns about half the market. What you can see in the video that's playing on the side is the sample goes directly into the tube, phlebotomist collects directly into the tube, and you can see the blood cells being pushed to the outside of the disc. We have a proprietary technology, patent pending technology, that allows us to get the blood cells to the outside and completely physically separate them from the plasma. So the plasma that's available in the middle of the disc is pure, clean plasma. It can be extracted either right at the point of collection, or it's stable within the disc to be sent in to a lab for testing. Next slide, please. So to summarize the process, the phlebotomist directly loads into the disc, which replaces blood collection tubes. It spins for between 15 seconds and 3 minutes, depending on how much blood, excuse me, and then pure, clean plasma, the highest quality plasma possible, can be extracted either at the lab or on site. Next slide. And the results are phenomenal. What we're seeing is that we have 100 times less hemolysis. This is the presence of hemoglobin, which comes from red blood cells breaking open. 100 times less hemolysis than collecting blood into a tube. We have a 10-fold reduction in cellular contamination. For example, DNA that is coming from cells breaking apart as they degrade in the tube. And this is important because in this very fast-growing area of DNA testing, we're looking for rare DNA. We're looking for DNA from cancer cells or DNA from a developing fetus. And it's a tiny part of the DNA that's floating around in the blood. If you dump the cellular contents from blood cells into that mixture, there are many times when you just can't find the rare DNA that you're looking for. We also have a much faster process. So we're streamlining the entire process and producing better quality at the same time. And lab directors get it. They know that centrifuging is the best way, and centrifuging right away gives the highest quality samples. Next slide. So our targets are lab and diagnostic companies. Our business model is to sell to approximately 100 companies, many of them in the US, but there are also companies in Europe and in Asia that are developing these high value tests. And these are markets which are growing rapidly. Liquid biopsy, which I mentioned, also sometimes called cell-free DNA, relates to cancer testing, also prenatal, and is also there's a growing area in transplant, looking at early signs of rejection, and also infectious disease testing. This is about $1 billion opportunity today, is projected to grow to $20 billion in the next 5 years. Similarly, with the at-home and point-of-care testing market, being able to do testing right at the point of care is facilitated by having a pure, clean sample. There are about 250 companies on our radar who are developing test systems for the doctor's office, and they're slowed down by having to deal with a whole blood sample. So they're basically all interested in partnering with us to get the cells out of the way, to have a pure plasma input, and we'll facilitate the growth of that entire market. So many exciting opportunities here, but it's also something that a small company can address because the customer set is limited. our customers will be doing the work of going out to the doctor's offices, to the satellite labs, and doing the training for the phlebotomists for them to use our discs. So it's a very efficient way for us to get to a very large market. Next slide, please. I mentioned our team at the beginning. If you look on the right side of the slide, Greg, Ulrich, and Sarah are the founding team. Greg and Ulrich are the inventors of the technology, and we're the scientists who are working at Sandia National Labs to bring this to bear. I actually joined the company as an investor and board member. I was so excited about the platform and about the team that I not only put money in, but I rallied a group of people who ended up being the largest investors in the seed round in the company. And I've been delighted to be working with the company. About 2 years ago, as the first product, Track, was coming to market, the team approached me and asked if I'd consider stepping in, as they're heavily scientific and really knew that they needed some commercial help. Todd mentioned that I've sold companies in this area before. I've been starting and exiting companies in the medical device space for over 30 years. The two largest exits were in the diabetes space. One sold to J&J and one sold to Roche. And our other senior leaders are people that I worked with at LifeScan, actually. Debbie, who heads up our clinical marketing effort, and Paul Manners, our CFO, both worked with me at the LifeScan diabetes company. And so we've got great expertise here. Next slide, please.
About 3 minutes, Karen.
Yep, the last one is coming up. So what do we need to grow? We're in the process of closing out a Series A funding and looking to add about $2 million to the current commitments. We're also looking for partners who can help us with market access to scale our male fertility product, Track. We're looking to meet the lab and diagnostic companies. It actually turns out our first commercial customer is a CRO, a clinical research organization, that is using mobile phlebotomy to go out and reach clinical trial patients anywhere. So they're very excited. We're actually getting them trained on Thursday. So right at the point of starting to deploy to our first customers for the zero delay plasma separation. And we're also looking for a high volume manufacturing partner. We currently manufacture everything in the San Francisco Bay Area at reasonable volumes, but we do need to scale with the demand that we see coming our way. We also know that manufacturing here is not very cost effective. So as part of our goal over the next year or so to drive down our cost of goods and be prepared for the demand that we see coming, we are looking to expand our manufacturing partnerships. So thank you for your attention, and again, appreciate the opportunity.
So, Karen, hold on the line for just a minute. So the interesting part about that is that's the first time we've done some mobile presentation. I'm pretty excited about that. Good job, Joe. It worked. Karen's a rock star in the diagnostic space, and we're excited to be part of what she's doing. We like that she's expanding into a sort of larger vertical, and so it's an investment on our balance sheet. It's small. It's $1 million investment on a $60 million balance sheet, but we're excited to watch what she does in the future, and hopefully we can make some introductions in this space. We've had some luck in the past 20 years in diagnostics and medical device, so we're excited to be part of what Karen's doing. Thanks again, Karen. Anybody have any questions for Karen? Okay, we're gonna move on because we're running out of little time.
Perfect.
Thanks, Karen. Thank you so much.
Thank you, Todd. Much appreciated.
Thank you. Osman Neuro is a company I founded while watching a TV program with my daughter on CNN. I was watching Sanjay Gupta talk about cannabis and Alzheimer's, and saw a doctor on TV, and I called him on the phone at USF and said, hey, I founded Patient Safety. It sold for $120 million to Stryker. I want to do something for Alzheimer's. I had read an article that basically everyone was failing. There were no new trials. No one was making any progress. And multiple years ago, I don't know when it was, Gary, I founded the company, called him up on the phone, begged Phil Mansour to fly to University of South Florida with me, got a licensing deal. This is an interesting biotech. It has a lotto ticket immunotherapy vaccine that is if approved, would be world-changing. And then it has a compound with 4 compounds that are already approved that we expect to be the market relatively quickly in the biotech space for a low cost of entry that has really meaningful results. DPW Holdings has a small, almost non-disclosable investment. It's not a lot. It's meaningful in terms of me that I like it, but it's harder to make investments into related party stuff because the independent board and various governance issues make it more difficult. We do expect to, when the time is right, increase our position. We asked them to come speak because we think it's a product that'll change people's lives in the Alzheimer's space. And it's really a compelling story. We do think it becomes meaningful to DPW later this year. It is something that I think all of the people online and the people here in this room are affected by Alzheimer's. My father has it. My wife's mother died from it. My grandparents died from it. Their parents died from it. All my father's brothers and sisters have it. It affects a lot of people. It's a big killer of people. Towards the later part in life, it's extremely expensive, and this is a really important topic. And so with that in mind, Stefan Jackman, we got a chance to hire him as CEO recently. Stefan spent a lot of time at Novartis, and I'm very pleased to introduce Stefan Jackman.
Thanks, Todd. Hello, everyone. I'm here to talk to you about Alzheimer's. Everyone in the room, can I see a show of hands who have a family member or know of anyone who's affected by Alzheimer's? So that's about 80% of the people. So thank you very much. Our mission in Alzheimer's is it's working to make Alzheimer's a memory. As Todd mentioned before, he founded the company in 2016. As he mentioned before, is that his family is affected by it, in addition to the current staff as well as the board members. When he founded the company, Phil Mansour, who's currently a board of director, a member of the board of director, was filling double duty. He's an MTIX CEO as well as Alzheimer's. Now he's transferred back to MTIX and the board of director. We have Will Horn, who is also the CFO of Alzheimer's as well, and he's currently back to the board of director, and of course, Milton Toddold. You know, you have myself. We hired Kent Cragen about a month ago, and Gary Gottlieb has been here from day one. He's director of business development. Next. So since I've started about 3 months ago, we kind of take the initiative of building a foundation for the organization. We've partnered and recruited a scientific advisory board, and it's going to start to grow. Right now we have 2 members. We recruited Dr. Thomas Wisniewski, Audrey Langone, Pearl Bartler Center of Memory Evaluation and Treatment. As you can see, he's a key influence leader and a scientific, pretty much expert within the field of Alzheimer's. He has a little bit over 19 patents and way over 300 peer-reviewed articles. We've also recruited Dr. Yung Fan, who's worked at the FDA and is very familiar with the regulatory process and procedures to take this drug to market. Well, actually 2 drugs to market. So our scientists and inventors are out of USF, Bird's Alzheimer Institute. We have Dr. Chow, we have Dr. Tan, and Dr. Scheidel. Our strategic partners, as you know, within a biotech firm, you don't want to be staff heavy. The most important thing is that we're focusing on the development of the technology, development of the drug, and taking it to market. As so, it's a massive undertaking, and it's extremely expensive. So we partnered with a CRO, TAMNet, and within TAMNet we have our pharmacologists, immunologists, toxicologists, and regulatory specialists, as you can see from the list here. Our approach is to really commercialize both therapy. As you know, as we mentioned before, many of our staff and board of directors are afflicted by Alzheimer's disease. So the last thing we want to do is turn this over to a major pharmaceutical company who may potentially shelf this drug. So we really do want to commercialize this. So our steps and processes moving forward is to make sure that we are patient-centric, that we do bring these therapeutic drugs to market to make sure that the 5.7 million people affected by it receive the treatment they so duly needed. Alzheimer's, as mentioned before, the 6th leading cause of death in the United States, affecting a little bit over 5.7 million people, and there's currently no therapeutic cure to Alzheimer's. However, there are 4 drugs on the market that manage symptoms. The last one being approved by the FDA in 2004. Next. The economic impact of Alzheimer's. It's a little bit over $277 billion, which is catastrophic when you think about it. If you're diagnosed with Alzheimer's, you can wither away for about 20 years. And that cost of the caregiving that your family, that yourself is affected, is astronomical. Current landscape of Alzheimer's. It's about 99 drugs in the pipeline. According to the World Health Organization, according to the FDA. Current clinical trials, if you go to clinicaltrials.gov, there's about 99 drugs in the pipeline. The first drug that will possibly or potentially hit the market and be commercialized is in 2023. Alzheimer's 2 therapeutic, in particular Libracel, which we'll get to, has a potential of hitting the market way before that, potentially 2021, 2022. Now we get to the good part. We have 2 drugs. We have Libracel, which is a lithium co-crystal technology, which is a lot of fun. It's great about this drug. So it's lithium, salicylate, and proline. When we talk about the science, I'm very excited about it because, as you know, lithium has been approved by the FDA as a mood stabilizer for bipolar disorder. However, it's utilized off-label for all psychiatric, pretty much, diseases. It's utilized for suicidality, bipolar, depression, and PTSD. Patient population, 40 million. Our lithium co-crystal technology is lithium, proline, and salicylate. Basically, it's 2 amino acids that combines to lithium that renders it non-toxic. If you are on the current lithium regimen, which is approved by the FDA, it requires a lot of blood monitoring. So on a weekly basis, monthly basis, you have to monitor your blood and get on or get off of the therapeutic based on the toxic nature. You don't want to die from it, of course. What happens with our current Libracel technology, because it is 3 compounds, lithium, salicylate, and proline, it's an 2 amino acid that pretty much renders it safe, non-toxic. And combined, then we co-crystallize the technology. And in co-crystallizing the technology, what it allows you to do is prescribe low dosage, but it has a greater bioavailability, basically a greater therapeutic index. So you can prescribe a lower dose, but you get a higher value for it. Concerning that, we have, so our process and the strength of that drug in particular, all 3 APIs are already approved by the FDA, which means we qualify for a 505(b)(2) regulatory pathway. What that means to us is that we get to skip a lot of steps that have already been conducted, which is even better for us. So where we are in that process is that we're getting ready. We're putting together our pre-IND package to meet with the FDA in the 3rd quarter of this year, followed by our IND. And meeting with the FDA, they may say, okay, you do a phase 1, 3 to 6 months. Depending on the results from the phase 1 testing, they can either take us into a 2A, B, or a combined phase 2 and 3 within the FDA, within human clinical trials. The results of that will allow us to also enter the market within 18 to 36 months, which is even better for us. The most important thing about this drug that I think is very exciting for us is that once it is in a patient, what we're going after, the indication is neurodegenerative disorders, Alzheimer's. Once it is tested and it's proven for neurodegenerative disorders, it can also be prescribed off-label for a psychiatric disorder when we talk about suicidality, PTSD, depression. So it really lifts that patient population for Libracel from 6 million to about 46 million patient population. It can be the go-to drug. This is something that can revolutionize the lithium therapeutic market, period. So this can be the replacement, the gold standard of all lithium that's currently on the market, in addition to for Alzheimer's. Our next drug is a mutant peptide. It's a vaccine, dendritic cell vaccine, that's developed by Dr. Chow out of USF as well. What that drug entails is that you inject into the hippocampus and you stimulate the immune system. Basically what you're doing is, as you get older, your immune system, of course, weakens. So you're regenerating, you're rejuvenating, you're bringing it up to date. So you inject into the hippocampus the vaccine, and what it does, it activates your white blood cells. But we also combine the mutant peptides that we combined with it, turns off your T cells. What happened with Elon's study is that when your T cells activated with your white blood cells, it created hydrocephalus, water in the brain, and patients died from it. That's not the case in our vaccine. What we've observed in the mouse models in preclinical is that 4 months later, after 2 inoculations, not only did it restore the cognitive abilities, it also cleared up the beta amyloid within the brain, which is the plaque buildup associated with Alzheimer's disease. Where we are in the process of that is that currently we're finishing out with Charles River Laboratories our preclinical trials in mouse. We're doing our tox studies, and that will be finished in May. Shortly thereafter, we're gonna meet with the FDA for our pre-IND, and then the IND, of course. So Q3, we should be filing our IND. Q4, we should be in human clinical trials. So both drugs this year will be in human clinical trials for us. Our process, or our next step after that, is to uplist in New York Stock Exchange and go public. Something that you can definitely follow us into our data room or online. We talk about the technology in depth, the science, and the results that we've seen in preclinical, and the reason why we believe that we do have 2 home runs. One being for agitation, stop Alzheimer's in its tracks, but also clearing up the beta amyloid. And another one, vaccine, which can also not only be a cure for Alzheimer's, but a prophylactic. Keep going. Keep going. Timeline. As we mentioned, it usually takes about 9 to 12 years to get a drug through the FDA. For us, we have Libracel, and both of our therapeutic can be fast-tracked. So when we talk about Libracel, it pretty much truncates the time. If we look and see where we are here with the red, we're getting ready to enter the clinic, our phase 1 this year. Phase 2 and 3, it can be on the market as early as 2021, 22. The last color on the slide here depicts it takes the FDA about a year to review your NDA when you do submit it. However, when you do partner with the FDA and you do have a fast-track status or breakthrough status, they will be a little bit more apt and pretty much become a consultant with you. What happened with both drugs, because Alzheimer's is an unmet need, there's really a heightened sensitivity to get something on the market as soon as possible, since, as mentioned before, the last drug that was approved for Alzheimer's was 2004. budget estimates. Of course, when we always talking drug development, we have to remember that it is a massive undertaking. It is going to be expensive. But concerning our process forward and what we've done in terms of fundraising, we're going to get there and we're going to make it. Of course, the investments with the DPW and other entities that we're currently working with, we are going to be able to finance and fund and raise the funds necessary to take both drugs to market. Our first focus, of course, being Liposol and then Child 22W. Let's get to the next slide. Let's get to the next one. So currently, the current therapeutic landscape, when you think about it, we have 4 drugs that's currently in the market. At the height, when the drugs were first approved by the FDA, as you can see per year, they make on average $3 to $4 billion. The cost per year per patient goes anywhere from $3,000 to $4,400. And the total revenues you can see from these drugs in 2017 is in the hundreds of millions. 2017 because, as you can see, these drugs are already in the generic form, of course. They're no longer the brand. So there is definitely room for improvement, and the market is definitely calling for the next big therapeutic drug for Alzheimer's. If we go to the next slide. When we talk about the commercial market evaluation, we have a patient population of 6 million. Even if Alzheimer's was to say, okay, fine, we're going to do a cost of $3,000 per patient per year at a 10% market cap, we're going to average, and this is just for one therapeutic, not for both, an average of 1.8 billion return on investment. So when you think about the cost to get both drugs to market, if you separate them out, it'll be about 75 million per drug, but the return on investment per drug would be an average of, at the very least, $1.8 billion. So the capital raise thus far, we will be filing within the next few weeks a Reg A to raise up to $50 million for the organization, so we can definitely use that funds to supply and get our drugs through the clinical trials. And this talks a little bit more about the Regulation A processes. And our strategic partners are listed here. We have Tamnet, we have Lonza. I don't know if anyone's really familiar with most of the strategic partners, unless you're really in the space. So, with that, I guess I'm going to end the presentation right now. And if you have any more questions, please look us up.
I think the most important part about the presentation is to understand that unmet need in Alzheimer's is going to be a big deal. Liposol has some other characteristics for Alzheimer's, which we'll talk about at another time. It's kind of a little bit of a Trojan horse for us. So I really think we'll be one of the unique biotechs that'll be to market with one of our drugs a lot quicker than most people. We have a very unique relationship with the University of South Florida. It's very supportive. We met Stefan through Tamnet, and I think it's a unicorn for us. I think that this Alzheimer's investment ends up being a big opportunity for everybody involved. DPW, through Cool Assist Technologies and Power Plus Digital Power, has a $50 million manufacturing contract with MTIX Limited. Inside the MTIX machines are 4 power supplies, which we'll talk about another time. We look at long-term engineering opportunities for Enertech to help with the future development of these machines as they go from 3 meter to 3.5 meter, and they go to different flatbed sizes. I'm 49 years old. In 20 years, I think I'm still going to be talking about this company. This is a global rollout of a product that is a complete category killer in the space of finishing textiles. It's one of the most polluted businesses in the world, the number 2 polluter in the world. It's one of my favorite investments. Besides Alzheimer's, I'd like to make sure my wife lives, and since her family got it, I hope she doesn't get it. This is one of my favorite investments I've ever made. DPW Holdings has a $14 million investment in the company. I think it represents a $100 million manufacturing opportunity per year for DPW for Digital Power. I think it represents a $1 billion opportunity for DPW Holdings in its investment. It's controlled by Alton Company. We're the largest voting shareholder of MTX International, along with Previn, the co-founder, the founder of the technology in England through MTX Limited. With that, Phil Mansour.
Thank you. As Todd mentioned, there are 2 distinct reasons why we're here today. One is associated with DPW Holdings being our largest investor in MTX International. Avalanche International, AVLP, is traded on the OTCBV under the symbol AVLP. The second is a very material contract which MTX Limited provided to DPC to build this technology and assemble this technology as we move it forward. This is the key reason for investment in AVLP DPW Holdings. We have a revolutionary platform. We own this technology. We don't license anything. It was built from the ground up by people who know technology. This is their swan song, not their first. This is a multi-billion-dollar marketplace. As we move forward through these slides, you'll see how big it is. We have changed the model that MTX Limited had several years ago of selling one machine at a time to licensing the technology on a per-meter basis. We're bringing a SaaS model with margins greater than 90% to the textile industry. A $1 trillion per year industry. Our technology is patent protected as well as key know-how protected. And our management is extremely experienced in the space. Let's watch a 90-second video about this technology and the business opportunity.
The cleanest, greenest technology to come to the textile industry with a SaaS business model. Introducing Multiplex Laser Surface Enhancement, or MLSE, charging by the meter in an industry that does more than 1 trillion meters per year. Featuring non-toxic treatments such as water and stain resistance without fluorocarbon chemistries. Fire retardation without toxic bromines or bromates. MTIX owns this proprietary patented surface synthesis technology. The per-meter tolling model provides gross margins up to 95%. Sustainable material synthesis at the push of a button, delivering virtually any combination of chemistries to the surface or the core of the substrate. Textile mills have been using traditional analog methods since the 18th century. MLSE introduces the digital finishing platform that revolutionizes the industry. For the first time in history, unmatched environmental savings can be achieved. Independent studies have shown results can be achieved, such as greenhouse gases reduced as much as 90%, chemical resources reduced nearly 95%, energy consumption reduced by over 99%, and water consumption reduced by 75%. MLSE, the world's first digital textile finishing platform.
There are 3 distinct stories with us, amazing stories in and of themselves. A science story, the ability to change a surface substrate with no toxic chemicals, no water, and very little energy. It's an incredible story. I'm not here today to talk about that story. There's a 40-minute town hall / presentation that was done in Amsterdam on our YouTube channel, MTIX YouTube channel, that you can understand a little bit deeper of how this technology works. Today I'm here to talk about the other 2 stories real quick. The first story is the environmental story. Look at this slide here. 90.9% reduction in greenhouse gas, 94.8% reduction in chemical usage, the second largest producer of toxicity on the planet, the industry of textiles, just behind oil. This is an amazingly dangerous, destroying industry, and we have a solution to help. We're not the only solution. Our company embraces all solutions that reduce chemicals and water waste, etc. But we can help this industry. 99.6% reduction in electricity. If you go through a textile plant, what you will see is fabric traveling hundreds and hundreds and hundreds of meters through machines with water, lots of chemicals, through dryers at 200 degrees Celsius. Moving that fabric takes energy. Moving that water takes energy. Drying that fabric takes energy. We have a piece of the textile process called finishing. We do that with 0 toxic chemicals. We do that with 99% less chemistry. We reduce the entire process by 75% water, depending upon our treatment. This is a major environmental green story. It's an incredible impact story. And most importantly, this is an incredible business story. The business model here is absolutely crazy. We got 1 trillion plus meters a year worldwide, breaking down, and that's just in apparel, 300 billion meters per year in technical textiles, commercial and industrial, and more than 200 billion meters per year just in household items. This doesn't include all of the things we can do with the MLSE technology. Todd talked about this company being around for 20 years and still talking about it. You're going to be talking about surface synthesis, sustainable surface synthesis, 100 years from now. This is a core disruptive technology. Next slide. Looking at the market a little differently. Just fire retardancy, 2+ billion meters a year. In automotive only, 490 million meters a year in the US. That's 18% of the worldwide automotive marketplace. All of that fabric inside the car must be treated with bromines and bromates for fire retardancy. The new car smell, toxic chemicals. We label it as a society, oh, a new car smell. It's toxic chemicals. We can treat that 490 meters a year just in the US with no toxic chemistries. Digital print preparation, 30 billion meters a year for print preparation, 10% of it, 3 billion meters a year for digital print prep. In that video, you saw material going through this sloppy mess, then going through a wash, and then going through a 110-foot long dryer. That was digital print prep, state-of-the-art today. We do that in a 20-foot machine, and that was one step of digital print prep. I think there's 14 steps. That one step we do with no toxic chemicals with 98% margin. Antimicrobial for hospitals, gowns, sheets, etc., drapes, 7+ billion meters a year. Airbags, 100+ million meters a year. People don't think about textiles, but they're all around you. Textiles are all around this room. Everything in here has to be fire retardant by code. The stuff, that wallpaper on the walls, that's textile. Our patents don't simply cover clothes or fabric. Our patents cover paper and film. This is an incredible investment. Now, as I mentioned earlier, when we purchased the company about 18 months ago and closed on it, they had a traditional business plan of selling machines customized to customers' needs. We worked with the team. We extracted the ability to make the machine. We contracted with DPC to build these machines and assemble them outside of this business so that we could create a generic platform where we had the software change. Now we can pick one machine. It can do fire retardancy, antimicrobial, defense warfare protection, the digital print prep. The list goes on and on and on. If you're at all interested, I encourage you to go to mtxinternational.com mtiax.com, look at the videos, and understand this technology. We have a very nice hockey stick economic ramp. By year 5, we're looking at $325 million in revenue and gross margins on the total gross margins of about 80%. It's important to understand, because I'm at a DPW Holdings conference, what this means to DPW Holdings as our largest investor. Obviously, their stock will reflect our performance. As a contractor of our machines, this model here is about 205 machines over 5 years. That's a significant chunk of revenue for DPW from us. Okay? We are way into the commercialization process of this technology. This is not technology in a lab. This is not technology that is experimental. This technology is more than 10 years in the making. This application of the technology, MLSE, is more than 30 years in the making. The inventor of this and the gentlemen on our board have more than 178 patents in MLSE, and these patents, which have expired, these patents have a full life on them, again, in film, paper, and fabric. Very important. We are deploying our platforms as they're being delivered by DPC, and our goal is to drive utilization, grow our platform base, and ultimately have the largest data library of chemical, photonic, and textile interactions on the planet. Our 5-year strategic plan moves from year 1, focusing on a few finishes. All of these have been independently tested and independently validated, and moving through different markets as we expand over the 5 years. You'll notice at the bottom are efficiencies. Beginning on this plan, we'll execute these numbers at a 15% efficiency on these machines year 1 on average. That's incredible numbers. We offer a digital solution to an analog problem. This technology is probably, said by many in the textile industry, a lot more experienced in the textile space than I. It's probably the greatest leap forward in the textile industry since the Industrial Revolution. Everything prior to this technology has been incremental steps of efficiency, making more efficient machines, making more efficient processes, incrementally year after year. This technology is truly a quantum leap. We combine all states of matter, photonics, high power energy, liquids, gases, and solids in a chamber to change the surface substrate. Next. Keep going. Let's look at the competitive landscape to us. Our competitors are mostly chemical companies and utilities, because that is what we displace. We displace the chemicals that go into the finishing process, the water that goes into the finishing process. And there are no technological solutions which, from a platform perspective, can do what we do. In fact, from a details perspective, when you look at the competition, you'll have a nanotechnology which can do something in the textile space. We're talking to those companies about being the delivery vehicle for their nanotechnology, because we get that technology into the fabric and into the surface substrate better than anybody else. The environmental story is incredible. I mentioned that as a second story here. Here are some incredible statistics. A single pair of jeans takes 7,000 liters of water to finish. A t-shirt, 2,700 liters of water. The world is just waking up to this toxicity nightmare. There are entire lakes that have been drained with boats sitting on the surface of a now desert simply because they've been drained for the textile industry. We cannot afford, as a planet, to continue down this path. And again, key investment thesis, MTIX owns its intellectual property. We have patents all over the world. and we have new patents coming. Any questions? Thank you very much.
So this is there'll be 3 slides. This is what I call the sum of the parts, and I have them categorized into. I have a much longer time horizon than our current shareholders. I'm looking at this at something that plays itself out over the next 3 to 5 years, and each one of these categories, I think there's $100 million plus opportunity in the technology group, the other bet segment, and DPW Financial Group. And so I've categorized them this way on purpose because I think that combined all of them have that kind of opportunity. I'm going to let Phil talk about some important milestones. I'll chime in a little bit here. Excuse me, Will. Apologize.
So as we ended 2018, we were really looking towards reduction of our debt. Again, I think that's one of the biggest constraints on our share price right now. Is the investment community is concerned about our ability to pay it down, candidly. So we have targeted about a $15 million reduction over 2019, of which we've reduced it by about $2 million so far this year. We've got preliminary agreements for another $2 million reduction, and I don't see any way why we can't get that debt obligation reduced this year. We'll still obviously use some debt at some of the subsidiaries. They have lower cost capital because their businesses have been around so long. Enertech's been around for 27 years,
right?
And it's just a different cost of capital over in Israel. Which goes to the second point, the operational lines of credit. Obviously, the price of Bitcoin has it's had an adverse relationship on the company's stock price over 2018 as the price of Bitcoin decreased. We're still in that business. We think there's a lot of value in that business. But as Darren and Marty pointed out, we have the ability with Digital Farms Inc. to move into the business when it's opportunistic. MTIX International's performance, the company has unmet demand. There's no other way to describe it. We think we'll deliver 6 to 8 machines this year, but again, that's dependent upon our ability to raise significant equity as opposed to debt capital this year.
The reduction of debt to match our long-term assets is a really critical conversation.
Which also has a big impact on our overall profitability.
Right.
If you look at the company's profitability or net loss for 2018 for the 9 months that have been reported, half of our loss is attributed to non-cash charges or cash-based interest expense.
Yeah, so about half of our loss is because of that short-term debt, and the capital structure is a little messed up. You got a price of DPW Holdings at under a $10 million, give or take, a $10 million market cap. You got $60 million of assets, and you got short-term debt that we're paid down. As Will mentioned, we paid down about $2 million of it so far this year. It's really become a nuisance for us in terms of matching our lenders to our long-tailed, long-term assets. That probably will lead to Alton Company making additional investments. We've made some. Alton Company's made some recent investments. Don't go too far. Alton Company's made some recent investments, and we tried to be patient to telegraph to the market by paying above market prices of 12 cents to demonstrate that we're committed. But at the pace we're going, we'll continue to make additional investment. And therefore reducing the debt, but of course increasing Alton Company's ownership of DPW Holdings. As I've said before, if you go on a look-through basis, I can actually buy assets cheaper by buying DPW. So the very assets that I own part of at Alton Company are cheaper to buy them through DPW. So the market's got it wrong, in my opinion. I'm wrong short term. I'll be right long term, in my opinion. The risk factors of access to capital will drive this $60 million in sales. I'm going to skip to the bottom and let him talk about delivery of machines. Acquisitions in the financial space. We already have several things going on in the DPW financial group sector. It won't be dilutive to DPW shareholders, in our opinion. So we are looking long term to reduce the need for DPW to issue equity and allow the subsidiaries themselves to have individual financing. Case in point, recently David and Almost got financing from Microphase directly at the subsidiary level. Almost has 2 bank lines with 2 Israeli banks with really great cost of capital. Almost isn't it under 4%? Is that right? 3.5. So there is a story of how we're going to be able to finance the subsidiaries and let the parent allow a little breathing room on the equity side of it. Even Digital Farms will finance outside of our balance sheet to allow us to get our equity value there, but have direct financing directly at Digital Farms. This number is achievable. It looks a little strange relative to a market cap of 10 million and sales potentially of 60 for 19. I think the number accelerates through 20, 21, 22, and 23, but we're not going to forecast out that far because clearly we've had some challenges on the equity side. I'll let Will talk about the delivery of the machines and we'll wrap it up with questions.
So historically, there's really been a couple of difficulties on the delivery of the machines. First, there's a learning curve, and with that learning curve goes along with it a higher price for the initial machines. So whereas we think we're going to get the cost of the machines down to, call it 1.6, 1.5 million, those first 3-4 machines really are closer to 2.3 to 2.4 million. That, of course, creates a challenge on the financing side. But also, even if we brought in the financing that we want to today in order to deliver on the 200 and plus machines that Phil was speaking about earlier, we still need to do some engineering work that we want to do in order to make sure that the gross margins at the DPW level, DPW Holdings and Cool Assist, is in line with what we've historically projected. We're looking at 20 to 25% margins on that revenue source, but if we can control the costs, we can get those up even higher. And then, of course, we talk about a $50 million purchase order on 25 machines. As things ramp up, there's demand out there for far more than 25 machines over the next year, 2 years, 3 years. I think Phil would like to get 500 machines out there if he could. That obviously would push our infrastructure a little too far.
Yeah, exactly. So important takeaways I think you should take away from this is that we're going to be opportunistic in what we sell. The restaurant group probably gets spun out this year, early next year. Digital Farms is doing a deal. We're excited about that business. We're still in Bitcoin. Amos is growing the defense business. Enertech will turn profitable this year. Microphase, we think, turns profitable. Power Plus, the new brand in terms of distributors there. Alzamend, we're going to have an investment in Alzamend. We're trying to make the story simpler. This is the first investor day we've ever had. I'm super grateful you guys were able to sit through 3 hours of us moaning and groaning up here. Alton Company, through Philu Ventures and my family fund, and Will and I are the largest outside shareholders. We I've said it 100 times, and hopefully in the reduced tweeting I do now and in public filings, we're going to buy more. Let that not be a secret to anybody when they wake up and say, why did Alt buy it down here so cheap? Maybe it's not, but I think it is. And with that, do we have any questions online?
You have a couple. One was back for Coolassist, and it was what happened to the backlog. It wasn't spoken about when the financial slide was shown.
Oh, we still have an extensive backlog at Coolassist, at Microphase. Amos, can you speak to the backlog at all?
Yeah, we got, I would say, about $18 million.
Right. So you look at we've been hovering around the 70 million with MTIX in there. That's plus or minus. I think that one of our top priorities to pay down debt is to push through that backlog. I think people forget we have receivables of, what are our receivables like right now?
Which ones?
Well, just combined.
7 million.
Yeah, so we have receivables of, I think, north of 7 million. So one of the ways we'll reduce debt is to capture that receivable out, lengthen some of our borrowing time, and push hard on getting that backlog delivered. There's really a go ahead, Amos.
Yeah, that does not mean that we're not going to be continuing to ship product and continue to fulfill the backlog.
Yeah.
It's not that we are shipping product and the backlog is reduced. We continue to get more orders.
Right.
We maintain a healthy backlog.
Right, so you maintain a healthy backlog by new orders. I think it's one thing that's hard to describe is that some of the work we do on the defense side is top secret. I don't have full secret clearance. Almost does in some cases. And I got to be very specific, but the Air Force contract for some product, they don't allow us to recognize the whole contract till we get ongoing yearly orders, but it's a really long contract. The new destroyer contract with Gresham is 10 years of recognizing that revenue. So the defense business, if you look at it, has this very long curve of backlog that will continue on, and that's why, depending on where the defense business ends up, it's a very valuable asset managed properly. Any other questions?
Where does our debt currently stand?
We reduced $2 million of our debt in the last month and a half. I think we stand somewhere.
2 million paper.
Right, so we'll probably the debt will end up down around 11 million, and going down. We're using Bitcoin and cash and some convertibles to pay down debt, and we have no plan. I feel like a lawyer standing behind me. We have no plans to take on any other short-term debt. I think Will have a tough time letting me sign anything that is not further out than a year to 3 years. The subsidiaries are borrowing money at considerably cheaper than the parent, and therefore we need to right-size what our debt structure looks like. Any other questions?
Yeah. What is the current public float outstanding?
The last report I think is 111 million, give or take. Anybody in house have any questions here? David?
Yeah, about MTIX. With regard to the funding there, one of the ideas I had or was wondering about was, is there any way that we can, I mean, if the demand is so great, which I believe it is, can we have a short-term time where we say to these big customers, hey, you pay for our machine for us, we'll give you a huge discount, we'll arrange something, but they'll help to capitalize these first few machines and get us off the ground. I don't see why we can't do something like that.
So, Bill's rolling his eyes. Sounds like when you talk to Bill. So, let me say that I've been holding on tight to the tolling model. It's no secret, I think, that we're in advanced discussions with a very large private equity firm and financing firm to finance machines. If we're not able to secure like a $30 million plus line of credit to build out machines and long-term equity for MTIX, then I could see that happening. But we're really close to getting a substantial line of credit. It's really important to understand the holding company structure is going to kick in, and you're going to see financing announcements at the subsidiary levels or the investment levels that don't dilute the parent. And it'll start to operate as these autonomous businesses that are a little disconnected from the parent a little bit, operating on their own with their own financing. But if we couldn't get, have any comment there? If we couldn't get that kind of financing, we'd probably have to go to a model where they pay up a little bit more for the machine?
Yeah, I think we would certainly consider it, but keep in mind the whole point of the first couple of machines was to prove out the model.
Right.
Was to show that you had consumers that were willing to pay a per meter charge. So I think we're reluctant to do that today.
What do you, Phil? You're going to add something to that?
The other piece that often goes unlooked or ununderstood is the build out of infrastructure. It's not simply building machines. As those first two machines roll out, it's building the internal infrastructure to service the machine.
Right.
So this is the best plan and the best use of capital to both move forward with machine building and infrastructure building.
If you ever been to a textile plant, when these machines are installed, we have to keep them running, and everyone's fabric's a little different. I'll give you a lesson I've gotten recently, and that is, it's not as simple as everyone makes it. Get wool from Australia. The nitrogen level in that wool from what they eat in Australia is different than Ireland. So all these fabrics have their own different algorithm and their own, what do you call it? Whatever Bill calls alchemy. They have their own little chemistry in terms of how they're serviced. And so infrastructure is going to be really important for that rollout too, not just money. But it'll get critical mass eventually. Will and I have been through it. We had a solution in the OR for patient safety, and I thought everyone would adopt it right away. We did the first sale, got it done in 6 months, got it through the Mayo Clinic, got it through Brigham and Women's at Harvard, and then no orders. No orders for a long time. Then all of a sudden we got 1, 2, 3, then 20, and now it's the standard of care. That took 9 years. What was supposed to be $2 million in 2 years was $18 million in 9 years. So, there you go. Any other questions internally? Well, a lot of the faces here I recognize. I appreciate you guys being here. With that in mind, any other questions online, Joe?
There was one that popped up multiple times. I don't know if you want to take it, but I'll give it to you. Hold on. Sorry. Do you see a feasible path that truly does not include an RS, big concern for long term?
I don't know why anybody in their right mind thinks I want to reverse the stock. Does it make any sense that I would want to? I'm the largest shareholder with Will. Why would I want to reverse it? The market cap is broke, yet the assets are there and growing. I think the only path to that is by July 4th, a much improved stock price. We're not on the NASDAQ, so we don't need $1, but we do need a significant improvement in the price of the stock. We're going to try to avoid it at all costs. We had this investor day to outline the opportunities there, but that the market will determine what we have to do there. Believe it or not, other than a spike up and down in Bitcoin and a declined price, we think we've done everything we said we were going to do. We've outlined this a couple years ago, and we're still on the same path we were to grow the business. We want to grow the top line sales to 100 million, and then we want to have a bunch of opportunities to shots on goal. We still want to be moving towards profitability at the end of 2019. And, if the market continues to undervalue the company, then they're going to continue to sell it to Alton Company, and then eventually we'll be the biggest shareholder. And if the market wants to take it down that path, it will. So that'll be up to the market. We're trying to do everything we can to deliver on what we said we were going to do. We think there's a lot of value here. We've added to the team internally at the parent company. Darren's doing some fun stuff. Phil's doing some great stuff. Stefan, the whole team is trying as hard as they can to deliver, including trying to stay awake during this presentation. So, anyways, with that in mind, thanks everybody. Take care. Bye-bye.